Yes, ma'am, you are live, ma'am. You can go ahead.
Okay. So shall I start from all the beginning?
Yes, ma'am.
So hi, good morning. We are talking about residential status of individual in this session. Residential status of individual is governed by Section 6 of Income Tax Act. To be specific, residential status of individual is governed by two sections, Section 6(1) and Section 6(6) of Income Tax Act. So let us proceed further and see what are the provisions regarding residential status of individuals. An individual can be basically divided into two categories. Either he'll be called as a resident or he'll be called as a non-resident. And once you identify that a person is resident, we have to further classify him as ordinarily resident or not ordinarily resident. Okay? Ordinarily resident or not ordinarily resident. Either we call him resident or non-resident, and further we classify him as ordinarily resident or not ordinarily resident. The provisions for classifying him as a resident and non-resident is governed by Section 6(1), the earlier sections which I had told you. Resident and non-resident classification is given by 6(1), and ordinarily resident classification is governed by Section 6 of Income Tax Act. So let us move further and see when will a person be called as a resident. Residential status regarding resident is divided into 4 different categories. A person may be called as resident if he falls in any of these 4 categories. He can be a resident under category 1. You may be falling under category 2, category 3, category 4. See, category 1 is a general rule which is applicable to all. General rule. And whenever we are talking about an act, what happens is, when I explain a general rule, simultaneously I will have to explain the exceptions as well. Those persons to whom general rule are not applicable or general rule are applicable but with certain modifications. That is what we call as exceptions. So we'll first see when will a person be called as a resident as per the general rule. Okay, as per the general rule, when will a person be called as resident? And the rule which I am discussing now, the general rule which I am discussing now, it is governed by Section 6(1) of Income Tax Act. So as per Section 6(1), under category 1, a person will be called as resident either if he satisfies basic condition 1 or basic condition 2. Let us see when will a person be called as resident under basic condition 1. We are all the questions for May 24 exam will be for assessment year 24-25, which means we'll have to collect data, we'll have to gather information for previous year 23-24. Okay, so we are identifying the total number of days of stay or the total amount of income, everything for previous year 23-24. So count the total number of days for which a person is in India in previous year 23-24, and if you get the minimum of 182 days in India stay, then you will be called as resident. 182 days means almost half a year, right? So you stay in India for at least 182 days during this year meaning financial year 23-24, then you will be called as resident in assessment year 24-25. All right. Now there is another condition, that is a person is not satisfying basic condition 1. Like if a person stays in India only for 100 days in previous year 23-24, he cannot be called as a resident as per basic condition 1. No problem. There is another condition, basic condition 2. And if you satisfy that basic condition 2 as well, you will be called as a resident. See, in between these 2 conditions, I have used the term or. What does that mean? You will be resident either if you satisfy basic condition 1 or you satisfy basic condition 2. So what does basic condition 2 say? Basic condition 2 says that in India during this financial year, that is 23-24, you will stay in India only for 60 days. Okay, 60 days. No problem. Still, you may be called as a resident if you satisfy another simultaneous condition. Another condition which goes together with that. What is that condition which goes together with that? Go back to the earlier 4 years. Which are the earlier 4 years? 22-23, 21-22, 20-21, and 19-20. Count all these 4 years together. Count all these 4 years together. And together, if you get 365 days, all 4 years added together, 4 earlier years added together, you get 365 days. Enough. That's it. You are a resident. Okay, previous year 23-24, you are here for 60, and earlier 4 years, you are here for 365. See, all these days are the minimums. So minimum, if you get all these number of days, you will be called as resident. Let me just give you an example regarding this. Let me just give you an example regarding this. Take a person who was in India for the various years as this. These are the various days of his stay in India in the various financial years. Okay, 125, and here let us make it 200. Can you tell me whether he is resident or non-resident for this year? Can you tell me whether he is resident or non-resident for this year? 23-24, he is in India for 100 days, and all the earlier 4 years data are also given: 25, 174, 125, and 200. What is his residential status? Is he resident or non-resident? What is his residential status? His residential status will be, in this case, his residential status will be resident. I think resident because when you count all the earlier 4 years, that is 25 plus 174 plus 125 plus 200, you get 524 days. So there is no 182 during the current year. There is no 182 during the current year, which means basic condition 1 is not satisfied. But doesn't he satisfy basic condition 2? He satisfies basic condition 2. So he will be called as resident. Okay, he will be called as resident. Any doubts? Any doubts from what I have discussed? Satisfies basic condition. 1 minute, 1 minute. Can you type it and give me that? Isn't that possible? Doubts. Any doubts? See your chats here. Let me give me a minute. I will discuss with the coordinator as to how to interact, right? Anyway, let me complete this. If you have any doubts, you may ask at the end of the session. Right. So in this case, in this example, he will be called as resident, okay? Because he has satisfied basic condition 2. He has satisfied basic condition 2. All right. Now let me change the example. What will be his residential status in this situation? Current year, he is in India for 50 days, and all the earlier 4 years, he is in India for 524 days. So he is not in India for 182. He is not in India for 182. That is not satisfied. Also, 60 plus 365 is not satisfied because you don't get 60, even though you get 365. That's not enough. 60 plus 365 has to be satisfied together. So in this situation, he'll be called as non-resident. Okay, here it is non-resident. All right. Let us move further. Let's move further. Let's move on and find out. Once a person is treated as resident, we know that we have to further classify him as ordinarily resident or not ordinarily resident. We have to further classify him as ordinarily resident or not ordinarily resident once you find that a person is resident. Understood? Now, what are the conditions for treating a person as ordinarily resident or not ordinarily resident? Those provisions are governed by Section 6(6) of Income Tax Act. So let us go to Section 6(6) of Income Tax Act. Again, here as well, as in the case of residents, for treating a person as ordinarily resident, there are two conditions. But the problem is, in between these two additional conditions, I have used the term and. I have used the term and. So what does that mean? You have to satisfy both additional condition 1 and additional condition 2 if you are to be called as ordinarily resident. Okay, both additional condition 1 and additional condition 2. Which means if you satisfy only one additional condition or you don't satisfy any of the additional conditions, then you will be called as not ordinarily resident. Okay, so we can straight away go to what are the additional conditions. The first additional condition says that we have all seen that he is a resident in previous year 23-24. That's not enough. You have to be a resident in the in any 2 years out of the earlier 10. So go back to the earlier 10 years, and in any of the earlier 10 years, in any 2 out of the earlier 10 years, you have to be a resident. Okay, I'll explain. Again, there is another condition. Go back to the earlier 7 years. And in those 7 years, all added together, you have to be in India for a period of 730 days. Again, let me explain. A person came to India for the first time in 2021-22. A person came to India for the first time in 2021-22. He was never in India prior to 21-22. 21-22 is the first year in which he landed in India. And during that year, he stayed here for a period of around 340 days. 22-23 also, he was in India throughout the financial year 22-23, he was in India. And during this year, he stayed in India for 214 days and then he left India. These are the total period of stay for the various financial years. Okay, these are the total period of stay for the various financial years of this person. All right, so let us see what is his residential status. In this case, he has satisfied basic condition 1 of 182 days and hence he is resident. Basic condition 1 of 182 days and so he is resident. All right. Now let us see whether he satisfies additional conditions as well. Additional conditions. So during this year, we have seen that he is resident. During this year, he is resident. All right, that's not enough. Go back to the earlier 10 years. And in those 10 years, in any of the 2 years, he have to be a resident. See, additional conditions are always looked into for the earlier years. You never consider current year's data for additional condition. When we check the additional conditions, you never look into the current year data. We always consider the earlier year's data for additional conditions. Okay, so we are going back to the earlier 2 years. That is 2022, 23, 21, 22, because only those 2 years data are available in this question. Prior to that, he had never come to India. 22, 23 also he is resident because 365 days. Basic condition 1 satisfied. Here also he is resident, 340 days. So resident. So additional condition 1 is satisfied. Additional condition 1 is satisfied. 2 out of 10 years. 2 out of 10 years. Now let's see what additional condition 2. Additional condition 2 says that go back to the earlier 7 years. Go back to the earlier 7 years. Here we have only 2 years data. Count those earlier 7 years and earlier 7 years added. Earlier 7 years added, we get 365 plus 340. You get only 705 days. 730 days condition is not satisfied. Additional condition 2 is not satisfied. Additional condition 2 is not satisfied, and hence he will be called as, what is his residential status finally? Resident, but not ordinarily resident. He'll be resident, but not ordinarily resident. Do you get that? Resident, but not ordinarily resident. Understood? So this is how we classify a person as ordinarily resident or not ordinarily resident. Right? So we had discussed now how a person is to be called as resident under category 1. And also, once you identify that a person is resident under category 1, how do we subclassify that as ordinarily resident or not ordinarily resident? So we have seen two things here. First, we have classified as a person as resident or non-resident, and then we have further subclassified that person as ordinarily resident or not ordinarily resident. Right. Now let us move on to category 2, 3, and 4 as well. What are the other rules? What are the other rules for residential status? Or category 2, 3, and 4 may be called as exceptional rules. Exceptional rule. See that a general rule is not applicable, or general rule is applicable to category 2, 3, and 4, subject to certain modifications. Subject to certain modifications. So let us first see to whom category 2 is applicable. Category 2. When will if you identify that you are a person who satisfies conditions of category 2, then you should not look into the general rule. There is another set of rule which is given for category 2, category 3, and category 4. Look into those rules and see whether you are resident or not. All right. So we are moving to category 2 now. Category 2. Category 2 or category 2 is applicable to two sets of persons. Category 2 is applicable to two sets of persons. Two type of persons come in category 2. Two type of persons come in category 2. Who are the two type of persons? There is set 1 and there is also set 2. These are the two categories of persons who come in category 2. That is, category 2 is applicable to two groups. Okay. What are the conditions, or who are the persons that are coming under set 1? Set 1 is applicable to an Indian citizen. You are an Indian citizen. You are leaving India during this year. You are moving out of India. You're going out of India during this year. And you are leaving India for these two purposes, either for employment outside India. Okay, either you are leaving India for employment outside India, or you are leaving India as a crew of Indian ship. You are leaving India as a crew of Indian ship. So these are the three conditions. If you fall in this category, that is, if you satisfy conditions of set 1, then you are in category 2. You are not governed by the provisions of category 1. You have another set of rules. Category 2 persons, they have another set of rules. You are an Indian citizen. You are leaving India, and you are leaving India for employment outside India or as a crew of Indian ship. Okay. Now let us see who all fall under set 2. Set 2. Set 2 is applicable to a person who is an Indian citizen, or you are a person of Indian origin. You are a person of Indian origin. Okay. You are staying outside, but during this year, you are visiting India. Okay, you are visiting India. Being outside India, you are coming on a visit to India. And third point, your Indian income. your Indian income does not exceed 15 lakh. That is, it is either equal to or less than 15 lakh. These are the persons who are governed by Set 2. So let us see, there are two categories, Set 1 and Set 2. Set 1 is applicable to an Indian citizen who is living in India and is living in India not as a tourist, but he is living in India for employment or as a crew of Indian ship. Set 2 is applicable to an Indian citizen or a person of Indian origin. He is visiting India during this year. So generally he is staying outside India, but during this year he's just coming on a visit to India. And his Indian income does not exceed 15 lakh, which means Indian income is equal to or less than 15 lakhs. Now, let us understand what is the rule which is applicable to these persons. I told you they are not governed by the general category. They are not governed by the general rule. They have another set of rules. So let us see what is the special rule which is applicable to this category. The special rule which is applicable to category 2 is that you are governed only by 182 days rule. That is, only if you satisfy basic condition 1, you will be called as. These persons, they have only basic condition 1. These persons, they have only basic condition 1. Basic condition 2 is not applicable to them. Basic condition 2 is not applicable. 60 plus 365 rule, if you satisfy, even then I will not call you a resident. I will not call you a resident even if you satisfy basic condition 2. You are governed only by basic condition. That is a speciality for these persons. That is an exception for these persons. So Indian citizen, leaving India, employment outside India, or as a crew of Indian ship. Indian ship. If you are leaving India as a crew of foreign ship, you won't fall under this category. Okay. Set 2, you are an Indian citizen or a person of Indian origin. Person of Indian origin means you or your parents or your grandparents, 3 generations, any of them is born in undivided India. Then only you'll be called as a person of Indian origin. So your grandparents might have migrated from India way back in 1950s or 1960s. They would have gone out of India. You were born outside India, so you are not an Indian citizen, but definitely I'll call you as a person of Indian origin. And staying outside there, you are coming on a visit to India. If you come to visit India for a period of 2 months, 60 days, you will not be called as resident. You will be called as resident only if you satisfy basic condition 1 of 182 days. All right. So that is a special rule that is applicable to category 2. Now let us come to category 3. Category 3. A person who is called as resident under another rule, category 3. Category 3 is applicable. Category 3 is applicable to a person who satisfies these 3 conditions. A person who satisfies these 3 conditions. Category 3. You are an Indian citizen or a person of Indian origin. You are visiting India, but your Indian income exceeds 15 lakhs. See, if you are an Indian citizen or a person of Indian origin visiting India, and if your Indian income is less than 15 lakh, you fall in category 2. If your Indian income exceeds 15 lakh, you fall in category 3. Now, what is the special rule category 3? Category 3, these persons will be called as resident. Either if you satisfy basic condition 1 of 182 days, that is always there. That is not the speciality. That is a general rule. The speciality is that you will be a resident if you satisfy this rule. 120 plus 365 days rule, if you satisfy, you will be a resident. 120 plus 365 days rule, if you satisfy, you will be a resident. 120 plus 365, that is 60 plus 365 rule has been slightly modified. That basic condition 2 has been slightly modified in case of category 3. Category 3, the speciality is that basic condition 2 is applicable, but there is a modification. It's not 60 plus 365 for them. It is 120 plus 365 days. This 120 during financial year 23-24 plus last 4 years added together, you are in India for 365 days. So this is a specialty for category 3 persons. You are an Indian citizen, person of Indian origin. You are visiting India during this year. You are just coming to India and leaving India. You are not coming to India for permanent stay. Understood. You are just coming to India for a visiting visa, and then your Indian income does not exceed 15 lakh, you come in category 2, 182 days. If your Indian income exceed 15 lakh, you come in category 4, 120 plus 365 days. Rule is also applicable to them. 182 is there always, but the specialty is that basic condition 2 has been slightly modified to 120 plus 365. Okay, and now the last category, category 4. Category 4. A person who will be called as resident under category 4. What does it say? Even if you are in India for 0 days, you have never visited India. That is, number of days stay is immaterial. Number of days stay is immaterial for these persons. Immaterial. Number of days stay is immaterial for these persons. Even if you don't come to India, you will be called as resident. And these persons are called by a special name called deemed resident. Deemed resident. And the provisions of deemed resident are governed by Section 61A of Income Tax Act. 61A. Number of days stay in India is not to be considered. Even if you come to India only for 0 days, you will be treated as resident. Okay, only for 0 days, you will be treated as resident. Do you understand? 61A is the section which governs these provisions. 61A. So let us see who are all covered under category 4. Who all are covered under category 4? Category 4 applies to an Indian citizen. Okay. Second point is Indian income exceeds 15 lakh. Indian income is exceeding 15 lakh and is not paying tax, not liable to tax in any other country or territory. Not liable to pay tax in any other country or territory because of residential status. Okay. So category 4 is applicable to a person who satisfies these 3 conditions. You are an Indian citizen, your Indian income is exceeding 15 lakh, and you are not paying tax in any other country because you are not a resident in any other country. Okay, you are not a resident in any other country, as a result of which you are not paying tax in any other country, then you will be called as a resident under Section 61A, even if you are your Indian income is, even if your total number of days of stay in India is less than 60 days or less than 182 days, whatever, we never look into the number of days of stay. So a person cannot be called as resident under the category 4 at the first instance. What you have to look into is when you proceed to do a problem, first of all, identify under which category a person falls. Category 1, the general rule, or category 2, the exceptional rule. That is, if he is an Indian citizen living in India, all those cases, or category 3. First of all, identify under which category do you fall. And you see that a person cannot be called as resident under category 1. He cannot be called as resident under category 2. He cannot be called as resident under category 3. Then, before you rule that person as a non-resident, before you call that person as a non-resident, also look into category 4. Before you take a final decision, see whether that person can be called as resident under category 4. Only if he cannot be called as a resident under category 4 also, you can go out of this and you can call that person as non-resident. Okay. So category 4 is not to be considered in the first instance. First of all, see whether he will be called as a resident under category 1, category 2 or category 3. Identify which category you fall in, 1, 2 or 3. You fall in category 2, but that condition is not satisfied. Before calling that person as non-resident, see whether he satisfies category 4 as well. Then only we can call that person as non-resident. One more thing. These category 3 and category 4 rules are applicable only to a person whose Indian income is more than 15 lakh. Okay. Category 3 and category 4 is applicable to a person only if his Indian income is more than 15 lakh. If your Indian income is less than 15 lakh, you won't fall under category 3 and category 4. Clear? Then another point. Earlier, we had classified as a person as ordinarily resident and not ordinarily resident, right? Ordinarily resident and not ordinarily resident. We had classified a person. We had looked into the additional conditions, all those things. Additional conditions. We had looked into the additional conditions. 2 out of earlier 10 years, we had seen whether he was resident. Earlier 7 years, we had seen whether he is in India for 730 days. All these points we had considered. Is it not? In order to treat a person as ordinarily resident or not ordinarily resident. Now, what I want to tell you is category 3 and category 4 persons. That is, you become a resident under category 3, satisfying the 120 rule. 120 or between, you are in India between for 120 days or 181 days. That is a special rule applicable to category 3. 120 days and 181 days you are in India, and I call you as a resident. A person who is resident under category 3 will be by default, always called as not ordinarily resident. Additional conditions are not to be considered. Additional conditions are not to be considered. You are by default not ordinarily resident. Did you understand? Similarly, category 4 persons also, that is a deemed resident, is also by default not ordinarily resident. Category 3-4 persons, if you are a resident under category 3 or category 4, you are not ordinarily resident. Need not look into the additional conditions. Need not consider the additional conditions. By default, automatically, by default means automatically you are not ordinarily resident. A person who has become resident under category 3 or under category 4 is always not ordinarily resident. So these are the rules regarding residential status of individual. These are the rules regarding the residential status of individual. So let us quickly recollect. Basically, there are 2 rules. Basically, a person will be called as resident or non-resident. Resident can be further classified as ordinarily resident or not ordinarily resident. Resident, there are 4 categories: general rule, and 2 and 3, 2, 3 and 4, but there are exceptions, meaning some modifications to the rule. General rule is there are 2 conditions, either 182 days during this year or 60 plus 365 days in the 4 earlier 4 years, 60 during the current year and 365 during the earlier 4 years. If you don't satisfy any of these basic conditions, then you will be called as non-resident. Category 2 is applicable to 2 sets of persons. And what is the speciality about category 2 is that you will be called as resident only if you satisfy basic condition 1 of 182 days. Basic condition 2 is not applicable to these persons. Who are the first set of persons who come under category 2? Indian citizen, leaving India, employment outside India, or as a crew of Indianship. Who are the persons falling under set 2 of category 2? Indian citizen or a person of Indian origin coming on visit to India. Indian income does not exceed 15 lakh. You are under category 2. You will be resident only if you satisfy basic condition 1 of 182 days. You have to be in India for 6 months during this year. Then only you will be called as resident. 2 months leave, you come to India, you are never called as resident. Category 3, again, basic condition 1 is always there, but basic condition 2 is slightly modified to 120 plus 365. This is applicable to Indian citizen, person of Indian origin coming on visit to India, and Indian income exceeds 15 lakhs. A person who has never come to India will also be called as resident. That is category 4. Even if you don't satisfy basic conditions, you will be a resident. Section 618, applicable to Indian citizen. Indian income exceeds 15 lakh. You are not paying tax in any other country or territory because you are not a resident in that country. Then you will be treated as a deemed resident, even if the basic conditions are not satisfied. Okay. So these are the four categories. Category 1 is a general rule. Category 2 is applicable to two set of persons, 182 and basic condition 1. Category 3 is applicable to Indian citizen person of Indian origin visiting India, their income exceeds 15 lakh. Category 4, a person who has never come to India, might be also called as a resident. Category 3 and 4 is applicable only if your Indian income is exceeding 15 lakh. Otherwise, category 3 and 4 is not applicable to you. And a person who becomes resident under category 3 or category 4 will be by default not ordinarily resident. Once we have seen that a person is resident, we will be seeing the additional conditions, ordinarily resident, and then two conditions, then only you will be ordinarily resident. If two conditions are not satisfied or only one condition, one additional condition is satisfied, then you will be called as not ordinarily resident. Okay. So 6.1 is over regarding residential status of individual. Regarding residential status of individual, 6.1 is over. Now we are coming to residential status of HUF. Residential status of HUF is governed by Section 6.2 of Income Tax Act. See, like an individual, we cannot identify the total number of days stay of an HUF in India because HUF doesn't come, HUF does not leave. So we cannot identify the residential status of HUF by counting the total number of days of stay. But we have some other set of rules in order to identify the stay of HUF. In order to identify a Hindu undivided family as a resident, what we will consider is the place from which the affairs of HUF are controlled, like place of control and management. Place of control and management. That is what we consider for HUF. Place of control and management. If place of control and management is wholly or partly situated in India, then that HUF will be called as resident. Okay. Place of control and management of an HUF is wholly or partly in India, then that HUF will be called as resident. So that will be called as non-resident if place of control and management is wholly outside India. It is wholly outside India, then that will be called as non-resident. And now, once you find that an HUF is a resident, we have to again further classify it as ordinarily resident or not ordinarily resident. And for that, the conditions are same as we discussed in the case of individual. Additional conditions. Go back to the earlier 10 years. See if he is resident for 2 years in earlier 10. Go back to the earlier 7 years. Add the total number of days stay and see if you get 730 days. All right. So those additional conditions which we have discussed in individual applicable for HUF as well. But additional conditions are not to be satisfied by HUF because we cannot say whether HUF is staying in India for 730 days. So additional conditions will be satisfied by the Karta of the HUF. The major person of an HUF is the Karta. So if the Karta satisfies additional conditions, Karta of a resident HUF satisfies both the additional conditions, then that HUF will be called as ordinary resident. If Karta satisfies only one additional condition, or he does not satisfy both the additional conditions, then that HUF will be called as not ordinarily resident. Let me give you an example. So we are talking about residential status of HUF. All right. There are two situations. This is situation 1 and this is situation 2. Okay. There are two situations which I am discussing. Situation 1, Karta stays in India for 30 days. Here, Karta stays in India for 300 days. Let us take additional conditions are satisfied. Additional conditions are satisfied. Yes. Here also I say yes. That is earlier to 10 years Tata was here for 2 years. Earlier 7 years Tata was here for 730 days. So all those earlier conditions are satisfied. Now, place of control and management. That is what we have to look into. Place of control and management, partly in India. This is wholly outside India. Wholly outside India. Let us identify residential status of Karta as well as residential status of HUF. Let us identify residential status of Karta as well as residential status of HUF. Let us identify both. The personal status of Karta as well as the status of HUF. Personal status of Karta. See, this person was in India only for 30 days. So basic condition 1 not satisfied, basic condition 2 not satisfied, 60 is not satisfied. And I also assume that Karta's income is less than 15 lakh. Indian income is less than 15 lakh. Meaning, if his Indian income is less than 15 lakhs, he will not fall under the category 3 and 4 situations which we had discussed earlier. So 182 days, 60 plus 365 days are the two rules which are applicable to him. He does not satisfy both. And residential status of Karta is non-resident. Karta is non-resident. How about HUF? How about HUF? HUF is resident and ordinarily resident. Resident and ordinarily resident, because place of control and management is wholly or partly in India. Resident. Karta of that HUF has satisfied additional conditions. Last year, Karta was resident in 2 years. Last 10 years, he was here for 2 years. Last 7 years, he was in India for 730 days. He has satisfied both the additional conditions. So this HUF will turn out to be resident and ordinarily resident. Okay. Now let us come to this case. Karta is resident and ordinarily resident because he is in India for 182 days. He has satisfied additional conditions. He is resident, ordinarily resident, but HUF has become, what is status of HUF? Non-resident. So what I want to mention here is, what I want to highlight here is, this is the line which I have to highlight. Current year residential status. Current year residential status of Karta is not relevant for determining residential status of his HUF. Residential status of his HUF. Current year residential status of Karta is not relevant. Current year. As we identify from this example, Karta is non-resident, but his HUF is resident. In this example, Karta is resident, but HUF is non-resident. So current year residential status of Karta is not relevant for determining residential status of his HUF. Of course, earlier years residential status of Karta, earlier years, preceding financial years status of Karta is relevant because he has to be here for 2 out of 10 years. He has to satisfy the additional conditions. So current year data is not relevant, but earlier year data is definitely relevant for determining residential status of this HUF. Okay. So that was regarding residential status of HUF. Okay. Now we move on. Residential status of company. Residential status of company. Provisions of residential status of company is given by section 6.3. 6.1 individual, 6.2 HUF, 6.3 is company. Company can be of two types. Indian company, which is registered under the Companies Act 1956 as 12 or 2013. And a company which is registered under the Indian Act. Indian company is always resident. Indian company is always resident. Nothing extra to be looked into. Only a foreign company may be called as only a foreign company can be a non-resident. Indian company can never be a resident. A foreign company can be a resident if POIM is in India. POIM means place of effective management. Effective management means the place from where the important decisions are taken, major decisions are taken. That is what is called as POIM. And what do you call an important decision or a key decision? What is an effective management? There are some criteria, but that is not discussed at the intermediate level. That will be discussed at the final level. So for the time being, you just need to know if POIM is in India, there is effective management is in India of a foreign company, then that foreign company will be called as resident. So a foreign company will be called as non-resident. POIM is outside India. Okay. And one more thing, only for individual and HUF, there are those ordinarily residents. Ordinarily residents. Only an individual will be called as ordinary resident. Only an HUF will be called as ordinary resident or not ordinary resident. All others, like company and any other person, partnership from AOP, BOI, artificial judicial person, from now on, there are only two residential status. From now on, there are only two residential status, either resident or non-resident. There is no ordinary resident status for a company, firm, AOP, or any other person. Only individual and HUF will be called as ordinarily resident or not ordinarily resident. Okay, so company is over, and the last category that is last person, residential status of any other person. This is applicable to any others. That is AOP, BOI, artificial judicial person, local authority. Everybody will be covered under this category. Any other person, and that is 6.4. 6.4. Under 6.4. Let us take an example, a partnership firm. When will a partnership firm be called as resident? A partnership firm will be called as resident if POCM, place of control and management, is wholly or partly in India. And POCM will be treated as non-resident. Partnership firm will be treated as non-resident if POCM is wholly outside India. So the rule is similar to that of HUF. How we classify an HUF as resident? The rule is same for partnership firm, AOP, POI, or any other person. So we have completed residential status, discussion of residential status of individual, HUF, company, or partnership, any other person. Now, why did we discuss residential status? Why did we discuss residential status? Because scope of income. Scope of income means whether an income is taxable in your hands or not. Whether you are liable to pay tax in respect of the income, that depends upon your residential status. That depends upon your residential status. Whether an income is taxable or not in your hands, that depends upon residential status. So for that, we have now identified there are three types of residential status, and we have two types of incomes. We have two types of incomes. An income when I receive, I can call either it as an Indian income or a foreign income. Two types of income, three types of residential status. What is the relationship? For which all incomes a resident has to pay tax, for which all incomes a non-resident has to pay tax, for which all income not ordinary resident has to pay tax. Okay. For that, we have to classify incomes as two. Either I will call an income as Indian, or I will call an income as foreign. Okay. There are two types of incomes, Indian income or foreign income. Indian income means you have received the income in India, or the approval happens in India. Approval meaning the reason to receive an income, the source of that income is situated in India. Okay. Source of income situated in India. Either receipt is in India or accrual is in India. Anything happens in India, then that will be called as an Indian income. Let me give you an example. I have a shopping complex which is situated in India, in Chennai. I have a shopping complex that is situated in Chennai. The rental income of this property, I'm staying in London now. I'm staying in London. I have a bank account in London. So I have asked the tenant to deposit the rental income directly to my account in London. Okay. The tenant deposits that rental income directly to my bank account in London. So receipt is happening in London, but the reason to receive that income, that is what we call it as accrual. The reason to receive an income is the shopping complex. And that shopping complex is situated in Chennai. So accrual is in India, and hence the income will be called as Indian income. Either receipt is in India or accrual is in India, that income will be called as Indian income. So from this, when will an income be called as foreign? When will an income be called as foreign? An income will be called as foreign when both receipt and accrual happens outside India. Let us continue the same example. My shopping complex is in London. The rental income is also deposited by the tenant in the London bank account. Receipt is outside India. Accrual is also outside India. Then that income will be called as foreign income. Okay. So there are two types of income, Indian income and foreign income. Now we have to find out the relationship between these incomes, that is, which all incomes are taxable in India, which are not taxable in India for various types of persons. One more point which I have to explain here is receipt means that is the first place where you receive the money under your control. The first time when you receive the money, that is a place of receipt. Any transfer or remittance to a second place will not constitute that income as a receipt in that place. Okay, let me clarify that. The rental income was first received in the London bank account. For the first time, I received the rent in the London bank account. And later on, I transferred this money. My money, it was received in my London account. Later, I transferred this from my London bank account to Calicut bank account, to Chennai bank account, to Indian bank account. Okay, I transferred this to an Indian bank account, a bank account in India. Do you understand? First time it is received in London. Later on, it was remitted to India. Even then, that will not be called an Indian income because what you have to consider is the first place of receipt. The place where you receive it for the first time under your control as your money. That is the first place of receipt, and any subsequent transfers will not constitute a receipt at the second place. It was decided in a case law of Cashier Mix Limited versus CIT. Okay. So this is regarding income. There are two types of income, and we have also seen that there are three types of residential status. Now let us see what is the relationship. What is the relationship? See, if income is Indian, you need not consider the residential status of that person. Because if income is Indian, you have to definitely pay taxes in India in respect of that income. You have to definitely pay taxes in India in respect of that income in India. So all Indian incomes will be added to your income, whether you are ordinarily resident, whether you are not ordinarily resident, or whether you are non-resident. Whatever is your residential status, you have to pay taxes in India in respect of this income. Okay, whether you are ordinarily resident, whether you are not ordinarily, whether you are non-resident, you are taxable in respect of these income. Indian income is taxable for all persons, irrespective of your residential status. Okay, now we want to move on to foreign income. Foreign income, R and OR, definitely you have to pay taxes here. I'm so sorry, the R and OR is once you find out that your person is resident and ordinarily resident, you need not waste time identifying whether it is Indian income or foreign income, because both Indian incomes and foreign incomes are taxable for R and OR. Resident and ordinarily resident is taxable for both Indian income and foreign income. Okay. Let me come to non-resident, and then I'll move on to not ordinarily resident. Non-resident is not taxable for foreign income. Foreign income is not taxable in India for a non-resident. So non-resident is taxable in India only for Indian income. All right. So that those two points are comparatively easy to remember. R and O are taxable for foreign income and Indian income. Not O are taxable for Indian but not taxable for foreign. Now let us come to not ordinarily resident. Not ordinarily resident is taxable for foreign income only if two conditions are satisfied. Two conditions are to be satisfied. If not OR is to be taxable for foreign income. First of all, that shall fall under the head profits and gains of business or profession. The income which you are receiving from the foreign country or that foreign income which you have received, that falls under the category profits and gains of business or profession. Second point, that business is controlled from India, wholly or partly, or if it is a profession, it is set up in India. Okay, so first of all, it shall fall under PGBP, profits and gains of business or profession. Second, so only a foreign business income will be taxable, or foreign professional income will be taxable for not ordinarily registered in India. Only foreign professional income or foreign business income will be taxable in India for not ordinarily registered. And that business or profession, business is controlled from India or profession is set up in India. Do you understand? So if it is a foreign income, and not ordinarily resident is to be taxed only for foreign business income or foreign professional income, falling under the head business. Foreign house property income is not taxable for not ordinarily resident. Foreign house property income is not taxable for not ordinarily resident. Understood. Foreign salary is not taxable for not ordinarily resident. Foreign capital gain is not taxable for not ordinarily resident. Other sources, foreign, is not taxable for not ordinarily resident. Now, non-resident is never taxable, but not ordinarily resident is taxable only for foreign business income. That too, another condition is that business shall be controlled from India or profession is set up in India. Okay. Now, I have to talk in this chapter, I will also have to talk about something called as deemed accrual in India. We have talked about accrual in India, right? We have talked about accrual in India. We also have to talk about deemed accrual in India. What do you mean by a deemed accrual? Section 9. Deemed accrual means, even though the income has actually been accruing outside India, it will be treated as if it is accrued in India, and hence it will be called as Indian income. So it will be taxable for non-resident as well. So Section 9, an income which has been classified as Indian income under Section 9 will be taxable for non-resident because there is an Indian income. Now, how do you explain that? What is called as a deemed accrual in India? The first point is business connection in India. Business connection in India. Let me explain that. What do you mean by a business connection in India? Let us assume that this Chennai SIRC, I'm talking about an example. Chennai SIRC is conducting coaching classes in Dubai. Okay. They are conducting coaching classes in Dubai. The classes are conducted in Dubai. Classes are in Dubai. It's not an online platform. Let us assume it's an offline platform. Classes are in Dubai, conducted offline from Dubai. And all the money, the fees relating to coaching classes, that was received in Dubai. That was received in Dubai. Okay. What does that mean? Accrual is foreign. Accrual is foreign. Receipt is also foreign. So at the first instance, we identify this income as foreign income. Is it not? This is foreign income. At the first instance, we have seen that this is foreign income. Accrual is foreign and receipt is also foreign. But let me explain something further. We have been conducted coaching classes in Dubai, and all the canvassing activities relating to this coaching classes were conducted from India. Like, there is a call center which is located in India, And the person in the call center, he had been making continuous phone calls to all the students situated in Dubai, staying in Dubai. And they have been canvassing about their coaching classes. And as a result of which, all these students, they came and joined the Dubai classes. All right. So I got a bunch of students in Dubai because of a business activity that was conducted in India. And what was a business activity that was conducted in India? Continuous phone calls which was being made from India to the students in Dubai. See, a single phone call to a single student will not make it a business activity. One of the fundamental reasons to call a transaction as a business is continuity, regularity, and frequency. So we did not go there personally to the various Indian schools and we did not personally canvass them. No marketing activity was carried out in Dubai. No marketing activity was carried out in Dubai. Instead, we had been calling them regularly from here, India, call centers, collecting all the phone numbers of the plus two students there. And we have been making continuous inquiries. And then we got a bunch of students. For them, we are conducting the classes now in Dubai. So approval happened in India, but for that approval, there was an underlying business activity which was done from India. That's just an example to explain what is a business activity or a business connection. Now, so in that case, I tell you, this income which is received in Dubai will be deemed to accrue in India, even though basically that is foreign. This is deemed to accrue in India, and hence that income will be called as Indian income, deemed Indian income, and that will be taxable for all. Whether you are, once it is Indian income, that will be taxable. Do you understand that? Okay, business connection in India. You have to identify the names, okay? Clearly understand what is the difference between business connection and business activity. Business control. Earlier you had used another term that was business control. Here I am using the term business connection. I'll further clarify that. Now, next point. Section 9, what is another point regarding deemed approval? You have an asset of property which is created in India. You have an asset of property which is created in India, and that asset of property which is created in India will be deemed to accrue in India. That was the first example which I told you what is regarding approval. That property or asset which is created in India is sold. So what is the difference between point number 2 and point number 3? Point number 2 is income from asset of property. Point number 2 is sale of property. Income meaning rent received. Sale is the capital gain which is received. Okay. Rent received from a property, that will be point number 2. That property is sold and you receive capital gain, that will be in point number 3. Both the cases, the property is situated in India. Fourth point, for salary, the place of approval is the place of service. For salaried persons, what we consider as place of approval is place of service. Okay, if your place of service is in India, then that will be deemed to accrue in India, that will be Indian income. Let me give you an example. I was working in India for so many years. Now I have retired and I'm staying in London. So my Indian employer is paying me pension. That pension is directly credited to my London bank account. Clear? That pension is directly credited to my London bank account. I'm staying in London now. The pension is also being deposited in the London bank account, but this pension is being given now for my earlier services in India. Is it not? Earlier services in India, I'm getting pension now. So that pension received will be treated as Indian income. Okay. Then, point number 5 is actually an exception for point number 4. Point number 4, I told you, for salary, what we look into as place of accrual is place of service. But point number 5 says that once the salary is given by a government, which means you are a government employee and your service is outside India, even then that salary received will be treated as Indian income, even if your service is outside India. So if you're a government employee, your place of service is immaterial. If you are a government employee, whether you are working outside India or whether you are working in India, that income will be always Indian income. Do you understand? And last point, an Indian company paying dividend, that is always deemed accrual in India. Indian company paying dividend is always deemed accrual. Okay. There are further points to be discussed here. So let me first just collect these 6 points and then we'll go to point number 7. Then we'll go to point number 7. There are 7 points in deemed accrual. Okay, there are 7 points. One is business connection in India. Second one is asset or property located in India, income or sale. Service in India, accrual is in India. But government employee, service outside India, even then that is accrual in India. Dividend paid outside India by an Indian company is always deemed to accrue in India. Now, what is point number 7C? Point number 7C. What is that point number 7? It is again regarding deemed accrual. Again regarding deemed accrual. 7 is applicable to 3 types of payments. One is interest, the other one is royalty, and the last one is fees for technical service, FTS. Interest, royalty, fees for technical service. Okay. Let me give you an example. Let me first talk about interest first. Then we'll go to royalty and fees for technical service. You are a non-resident. You are a non-resident. Okay. You have lent money to the government of India. Lent money to the government of India. In return, what will the government pay? Government will pay you interest. Government will pay you interest. Now, what does section 9 say? Once government pays interest, it is always Indian income. We did not look into anything further. Earlier, we told that government paying salary, that is always Indian income. Similarly, when the interest is being paid by government in the hands of recipient, that will be always treated as deemed accrual in India. Okay. So NRI is lending money to government of India. In return, government is paying, let us take the US president. US president is lending money to Indian government. Okay. US president is receiving interest from Indian government. Indian income, that will be treated as Indian income in the hands of US president. If Indian government pays interest, that is always Indian income. Same is the case with royalty. Same is the case with fees for technical service. All right. Now let us move further. Once it is paid by Indian government, that is always Indian income. Once it is paid by Indian government, that is always Indian income. Okay. Let's move further. Again, you are an NRI. You lend money to, let us take Virat Kohli. Virat. NRI lent money to Virat. Virat is now paying interest. Virat is paying interest to non-resident. US president. Let's take US president, same example. Earlier, US president had lent money to government. Now, US president is lending money to Virat. So, Virat is paying interest. Virat means it is resident. Resident is paying interest to non-resident. Whether that will be Indian income. That will be Indian income if Virat uses that loan in India. The money which is lent by government, is used in India by Virat. It is used in India by Virat. What Virat has to use in India? The services of US president. The services of non-president has to be used in India. What was the service which was given by non-president here? He had lent money. So that money shall be used by Virat in India. Virat uses the loan amount in India. Loan amount. In other words, the services of that person is used in India. Then in the hands of the recipient, that interest will be treated as Indian income. Okay. Now let us move further. Again, you are a non-resident. You have lent money to Messi. Okay. Another non-resident. So who is giving you interest now? Messi is paying interest to non-resident. One non-resident paying interest to another non-resident. Whether that will be Indian income. Again, it will be Indian income. It will be Indian income. If there are two ifs here. There are two ifs. What are the two ifs? Messi uses loan amount in India. That is the first point. Messi uses loan amount in India. And second if is that there are one more if, both the if. That shall be used in India for business or profession. Messi has to do business or profession in India using the money which was given by the non-resident. Okay. So let me show you that rule regarding this. Rule regarding this. See, nature of income is interest, royalty, fees for technical service. It can be paid by, that interest can be paid by either government, it can be paid either by resident, or it can be paid either by non-resident. The three situations which we discussed. Government paying interest to US President, Virat Kohli paying interest to US President, or Messi paying interest to US President. Okay, what is the rule? If it is paid by Indian government, it is always treated as Indian income. If it is paid by Virat Kohli, it will be treated as Indian income. If the services of non-resident are being used in India, which means the money which was lent by the non-resident was used in India by resident. Okay, then in the hands of the non-resident, that will be treated as Indian income. And the third case is the money which was lent by Messi shall be used in India for business or profession. Okay, so there are two conditions. Each step we advance further. See, paid by government, there are no ifs. Paid by government, there are no ifs. It is always Indian income. Paid by resident, one if. What is that one if? Used in India. Paid by non-resident, there are two ifs. What are the two ifs? Used in India, used for business or profession in India. You understand? Now, what if all these payments are like royalty and fees for technical service? Royalty, again, if it is paid by Indian government, that is always Indian income. Paid by Indian government, that is always Indian income. Paid by resident, it is Indian income. Same rule. Indian income, if it is used in India. Paid by non-resident, again, if it is Indian income, it is used in India. Non-resident business or profession rule is not applicable. Business or profession rule is not applicable for non-resident. The only thing which I have mentioned is there, which has to be used in India. Used in India, that is enough. Fees for technical service also same rule. Government is always Indian. Resident or non-resident is Indian if it is used in India. So it has to be used in India for business or profession. See, that is applicable, business or profession, that additional if is applicable only for interest paid by non-resident. Only for interest paid by non-resident, it has to be used for business or profession in India. In all other cases, the only condition is whether it is paid by resident or non-resident, it has to be used in India. It is to be treated as Indian income. The only rule is it is to be used in India if it is to be treated as Indian income. But if it is an interest which is paid by non-resident, it is to be used in India for business or profession. Okay. So that was regarding the rule regarding the scope of income. Okay. Now, what further which is to be explained here is, here we had explained a rule regarding 15 lakhs Indian income. We had discussed a rule regarding Indian income exceeds 15 lakh, or only if Indian income exceeds 15 lakh, you fall under category 3 and category 4. We had explained that rule, right? Now, for the purpose of Indian income, we have seen what is Indian income, either receipt in India or accrual in India, but there is one more explanation there. What is that explanation? See, there is a foreign business income, or there is a foreign professional income. Foreign professional income. Foreign business income, or there is a foreign professional income. Okay, basically, that income is foreign. It is from business or profession. Okay. And this foreign business income or foreign professional income, as we explained in that exam, that is controlled, business is controlled from India, or if it is a profession, business is controlled from India, or profession is set up in India. Okay. Business is controlled from India, or profession is set up in India. What is the nature of this income? Ideally, what is the nature of this income? Nature of this income is foreign, ideally. But for the purpose of calculating Indian income, for the time being, just for the sake of calculating 15 lakh, for the time being, this will be treated as Indian income. Just for calculating Indian income, just for calculating that 15 lakh, just for that purpose alone, only for that purpose, this foreign business income controlled from India and foreign professional income set up in India will be treated as Indian income. That is, while counting 15 lakh, this will be included. For the time being. I know it's not foreign in nature, it's not Indian in nature, it's not ideally Indian in nature, but just for the sake of calculating 15 lakhs, for the time being, this foreign business income controlled from India or foreign professional income set up in India will be treated as Indian income. Okay. So I think we will do one problem from residential status. All right. We'll do one problem from residential status, that is regarding, we'll be doing the problem from RTP and PP. Let us see one question from that. Yes. This is a question from your institute examination, suggested answer November 2022. Let us read this question, November 2022. This is a question from November 22. We'll read this question and we will discuss this. We'll see. Mr. Sarthak, an individual, an Indian citizen, living abroad, Dubai, is a tax haven, who's not paying taxes there since year 2005, and he never came to India for a single day since then. Okay, so he has not come to India during this year, and he has earned the following incomes during the year 2023-24. There is an income which is accruing and arising in Dubai, and that was not liable to tax there, 20 lakhs. Income accrued and arisen in India, 5 lakh. Income deemed to accrue or arise in India, 8 lakh. Income arising in Dubai from a profession which is set up in India. Determine residential status of Sarthak and taxable income for previous year 23-24. Assuming he has no other income during this year. Now there are another questions 2 and 3. What would be your answer if income arising in Dubai from a profession set up in India is 2 lakh instead of 10 lakh? What would be your answer if Sarthak was born in Dubai and his parents were born in India? So let us identify the first case. We have to first see under which category he will be called as resident, whether he falls under category 1, category 2, or category 3. Okay, whether he falls under the exceptional category or category 1, 2, and 3. In this case, he is an Indian citizen. Okay, he is an Indian citizen. He is visiting India. In this question, it is given that he is not visiting India for the year, but even then, at least if he comes to India, he will come under the category 2 or 3, visiting India. And now we have to see whether his Indian income is more than 15 lakh or less than 15 lakh, because more than 15 lakh means he will come under category 3, and less than 15 lakh means he will come under category 2. Do you understand? More than 15 lakh, Indian citizen visiting India, more than 15 lakh, he will come under category 3. Less than 15 lakh, he will come under category 2. So let us see how much is his Indian income. Point number 1, income accruing and arising in Dubai. That is definitely foreign income. 20 lakhs is foreign income. Okay, 20 lakhs is not to be considered. 20 lakh is definitely foreign income. So this is not Indian income. Income accruing and arising in India, 5 lakh. That is Indian income. Do you understand? 5 lakh is Indian income. Income deemed to accrue or arise in India. Deemed to accrue means it is as good as Indian income. So that is again Indian income. 5 is Indian income. 8 is Indian income. Income accruing in Dubai from a profession set up in India. Okay, income arising in Dubai from a profession set up in India. For the time counting 15 lakhs, we have to treat this as Indian income. While counting 15 lakhs. So 8 plus 5 plus 8 plus 10. That comes to 23 lakhs. Okay. So let us write down what we have understood from this question. What we have understood from this question. Let us write down. He is an Indian citizen. He is an Indian citizen. He is visiting India. His Indian income is 23 lakh. The Indian income is 23 lakhs. So, which category he would fall into? He would fall under category 3. Indian citizen or person of Indian origin coming visiting India, Indian income exceeding 15 lakh. And what is that rule which is applicable to him? The rule which is applicable to him is 120 plus 365 days rule. 120 plus 365 days rule is applicable to him. But his stay in India is 0 days. So he is non-resident under category 3. He is non-resident as per category 3. Okay? He is Indian citizen, visiting India, Indian income is 23 lakh. So generally he should come under category 3. That is 120 plus 365 days is the rule which is applicable to him. But his stay in India is only 0 days. So he is non-resident if we go for as per category. Category 3, he is non-resident. Right. But before we rule out the residential status, we have to see whether he will be a resident under category 4. Even if he is in India for 0 days, he will be a deemed resident. He will be a deemed resident. You have to see that. Okay, you have to see whether he is a deemed resident. So let us see whether the conditions of that deemed residential status is applicable. Yes, he is an Indian citizen. His Indian income exceeds 15 lakh. He is not paying tax in any other country. So what will be the answer? Deemed resident under section 61A. He is deemed resident under section 61A. And a person who is a deemed resident under section 61A is by default resident but not ordinarily resident. By default, he is not ordinarily resident. Did you understand the terms? So we have determined the residential status. Now, what I want to explain at this point is, when you write for the exam, there is a specific way in which we have to explain the answer, something which we do in law as well. Here also we have that 3 steps in which we have to write the exam. First is we have to give the reference part. That is, we have to explain here that he is falling under 61A. All those provisions regarding 61A has to be explained. So first of all, you have to say that since he is an Indian citizen visiting India and his Indian income is exceeding 15 lakh, the rule which is applicable to him is 120 plus 365 days. That is the category 3 rule. See, never use the terms category 1, 2, 3, and 4 in your answer, because this is just which I have used the categorization which I have made so that we can easily place a person. For that purpose, I have given this category 2, 3, and 4 and all. What you have to do is you have to write that rule which is there. A person who is an Indian citizen visiting India and his Indian income is 15 lakh, more than 15 lakh, then he will be a resident if he satisfies that 120 plus 365 days rule. He does not satisfy that 120 plus 365 days rule, so he's never a resident as per section 6.1. As per section 6.1, he is not resident. But a person will be a deemed resident under section 6.1A if he is an Indian citizen, Indian income exceeds 15 lakh, and he is not paying tax in any other country. So the provisions of 6.1A are satisfied. So that is the inference part. SIRC satisfies conditions mentioned in 6.1A. His Indian income is more than 15 lakh. You have to show that calculation. 23 lakh. How did you get that 23 lakh? That is more than 15 lakh. He is an Indian citizen. He is not paying tax in Dubai. So he is satisfying conditions of section 6.1A. Even if he stays in India only for 0 days, he is being resident under section 6.1A. So that inference, and finally the conclusion. He is deemed resident, and deemed resident is by default. Resident but not ordinarily. This is how you have to write for the exam. All right. First of all, the relevant section which is applicable that we have to mention. And this is how they answer in the answer key as well. When you look into the suggested answers or RPPs and MPPs, everything will be done in this order. So please try to maintain that order in which you write the exam, the reference part, the inference part, and the conclusion part. So we have determined in this question, we have determined the residential status. Okay. We have determined the residential status of Sanford. That was the first part of the question. We have determined his residential status. Next cases, determine his taxable income for assessment year 23-24. So we have to look into that rule. What all incomes are taxable for not ordinarily resident? The rule which we had discussed earlier. What all incomes are taxable for not ordinarily resident? We have identified that he is a not ordinarily resident. So what all incomes are taxable? Indian income is always taxable, no doubt about that. Indian income is taxable for not ordinarily resident. Foreign income is taxable only if 2 conditions are satisfied. What are the 2 conditions? It shall be from business or profession, and that business or profession shall be controlled from India, or profession is set up in India, but non-resident is not ordinarily resident. Foreign income is taxable only if it is from business or profession, and that is controlled from India or set up in India. Indian income is always taxable. No need to talk about that. Indian income is always taxable for not ordinarily resident. Foreign income, 2 conditions. Now we'll find out what is the stock income. So let us see the first income. income accruing and arising in Dubai, that is definitely foreign income that is not taxable. And it's not given whether it is business, whether it is business or not, that is not directly given in the question. So I assume that it's not business or profession. And also it is not given whether it is controlled from India. So even if it is business or profession, it should be controlled from India to be taxed. So since those details are not given, I completely assume that that is not business income or professional income, and hence that is not taxable. 20 lakh is not taxable. Income accruing and arising in India, 5 lakh is fully Indian income, that is fully taxable. Income deemed to accrue or arise in India as good as an Indian income, that is fully taxable, 8 lakh. Income arising in Dubai from profession, and that profession is set up in India. Foreign professional income set up in India, that is also taxable for not ordinarily resident. So total income will be 5 plus 8 plus 10, 23 lakh. 23 lakh is taxable. Okay, 5 plus 8 plus 10 is equal to 23 lakh. Now we answer the second part of the question. What would be your answer if income arising in Dubai from a profession set up in India? That last point, it's not 10 lakh, it's 2 lakh. It's 2 lakh. In this case, his Indian income will be, instead of 23, in second part, his Indian income will be only 15 lakh. 15 lakh. What does that mean? His Indian income does not exceed 15 lakh. Does not exceed 15 lakh. So he will fall under category 2. He will fall under category 2. Category 2 means you have to be in India for 182 days. You don't satisfy that rule. Hence, you are non-resident as per category 2. You are non-resident as per category 2. Okay. Indian income is 2 lakh. That is professional income in Dubai controlled from India is only 2 lakh. You are non-resident under category 2. And 618 is also not applicable. 618 is not applicable. Why 618 is not applicable? 618 is applicable only if your Indian income crosses 15 lakh. So in point number 2, your status will be non-resident. In point number 2, your status will be non-resident. You cannot be called as a resident under 618 as well. So you will be non-resident. Okay. So in that case, if he is a non-resident, he will be taxable only for Indian income. And how much is this Indian income? 8 plus 5 is 13. 8 plus 5 is 13. Okay. Now, last case. What would be your answer if Sarkar is born in Dubai, which means he is not an Indian citizen? If it is not an Indian citizen, if he is born in Dubai, but his parents are born in India, what does that mean? He is a person of Indian origin. He is not an Indian citizen. The question initially started saying that he is an Indian citizen, but now he is not an Indian citizen. If he is not an Indian citizen, even then, Indian citizen or person of Indian origin coming on visit to India, it is 182 days. 182 days. He is not a resident under 182 days or even 120 plus 365. And the additional point which I have to mention here is, even if his income is more than 15 lakh, 618 is not applicable because 618 is applicable only for Indian citizens, not for persons of Indian origin. 618 is not applicable to persons of Indian origin. It is applicable only for Indian citizens. So again, he is non-resident. He is not deemed resident under section 618. It's not deemed resident under section 618. So he will be non-resident in point number 3 as well. Point number 3 as well. Point number 2, he was non-resident because his Indian income is less than 15 lakh. That is, does not exceed 15 lakh. Point number 3, he is non-resident because 618 is not applicable as he is not an Indian citizen. Again, non-resident, and his total income will be only 13 lakh. 5 plus 8. Indian income is only 13 lakh. Okay. So we have completed chapter 2 of residential status. We have completed. We'll take a break. And in the next session, we will discuss about salary. Okay, we'll start with salary in the next session. All right. Thank you so much. All right. So now let us continue the next session. The next topic which we are going to discuss is income from salary. All right. So next topic which we'll be discussing is income from salary. So first, let us find out what is the format for computation of salary income. Okay. There are 5 heads of income. There can be salary, can be house property, can be business income, can be capital gains, and income which cannot be classified under the other 4 heads. We'll be calling it as other sources, which is not salary, which is not house property, which is not business income, which is not capital gains, can be called as other sources. All these 5 heads of income will together be called as gross total income. From that, we can claim deductions under Chapter 6, and the balance is called as net income or the taxable income upon which you have to pay taxes. So we all know that the 5 heads of income: salary, house property, business income, capital gains, and other sources. Now we are going one by one. We'll be discussing each head of income. All right. The first income which we are discussing now is income from salary. Okay. This is the first income which we have to discuss. It is income from salary. First of all, you have to see what are the conditions for charging an income under the head salary. When do you call an income as salary? The first and foremost point is that the relationship between the employer and the employee. Okay. That is, the relationship between the employer and employee should exist between the payer and the recipient. Do you understand? The relationship between the employer and employee should exist between the payer and the recipient. So in the absence of the employer-employee relationship, you cannot call an income as salary income. So that is the first point: employer-employee relationship. Second point is that ideally there is no difference between salary and wages. You know that the daily wages, somebody gets daily wages, or a person gets salary. Both salary and wages are the same for the purpose of taxation. We both tax salary and wages under the head income from salary. There is no separate head to charge wages. Salary and wages will be charged under this head. Third point, you may work with more than one employer. You may work with more than one employer, meaning part-time employment is also possible. Part-time employment is also possible. Like employment need not necessarily mean it is a full-time employment. You may work from 9 to 1 with one employer, 2 to 5 you may work with another employer, or alternate days you can work with different employers. It's all your wish. You may work with more than one employer, and salary received from all those employers together will be called as income from salary. Fourth point is salary may be received from past employer, present employer, or a future employer. What is salary received from a past employer called as pension? Pension is a salary which we receive from a past employer. So salary received from past employer will also be taxed under this head. Fifth point is that salary must be real and not fictitious. Fictitious means something that exists only in paper. It's notional. There is no real salary which is received, something which is written only in paper. That salary will not be called as salary. It has to be salary. It has to be real salary. Then foregoing of salary will not make salary tax-free. Foregoing means waiver. That is, you voluntarily tell your employer you don't want salary. The employer had already given you the salary, but you ask the employer, you are saying employer, no, sir, I don't want salary for this month. You may not be receiving salary, fine. You received only 11 months salary, 12 months salary you waived. But even then, you have to pay taxes for 12 months salary. Okay, taxes are to be paid for 12 months salary. 7th point is surrender of salary to a government fund, and that is under a special act of the government. Even if you surrender salary to that government fund, that salary will be tax-free. There's a special government for exemption from Taxation Act. So 12 months salary, if you surrender to that government fund, then you need to pay tax only for 11 months salary. And salary can be of three types: salary, allowance, and perquisite. So these are the 8 conditions to tax an income under the head salary. The first and most important point is relationship between employer and employee should exist between the payer and the recipient. Salary and wages are the same. There is basically no difference between salary and wages, whether it's a white collar job or a blue collar job. That will not make any difference for this purpose. You can work with more than one employer. Part-time employment is possible. Salary may be received from past employer, present employer, or future employer. Salary must be real and it is not fictitious. Foregoing of salary will not make salary tax-free, but surrender will make salary tax-free. Surrender to that particular government fund will make salary tax-free. You need not pay taxes on that month's salary you have surrendered. And there are 3 types of salary. Salary can be classified into 3 types: salary, allowance, and perquisite. I will first explain what is allowance and perquisite, and then I will go to what is salary. Okay. So as I told earlier, there are 3 types of, whenever an employee pays you something, I can either call it as salary or can call it as allowance or a perquisite. All these 3 added together will be called as gross salary. Whenever you hear of the term gross, you have to understand that there is something further which we can claim as deductions from that. From gross profit, we deduct a lot of other expense to arrive at net profit. From gross total income, we claim deductions under Chapter 6A to arrive at net income. Similarly, from gross salary, we have to claim 3 deductions, and those deductions are mentioned under Section 16, and the deductions are standard deduction, entertainment allowance, and professional tax. These 3 items deducted, we arrive at taxable salary, the final taxable income under the head salary. So now let me explain what is the difference between salary, allowance, and perquisite. I will first explain what is allowance and perquisite, and then I will move on to salary. Okay, let me first explain what is allowance. Allowance means it is a fixed sum of money. Okay, so allowance is always received in cash. It is always received in cash. It is a fixed sum of money that is given periodically, meaning that will be given monthly or sometimes that will be given weekly. That varies, that depends. It will be given periodically, monthly, daily, it can be weekly, half yearly. That period will be determined by the employer. So many things under the head salary that is determined by the relationship or the agreement which is made between the employer and the employee. So here also the allowance, employer might decide to pay periodically, like half yearly or monthly and so on. Okay, that is given periodically. And allowance is given to meet a specific expenditure. It is given to meet a specific expenditure. That expenditure may be official or personal. Expenditure may be official or personal. Do you understand? Like many times we can understand what is this allowance given for from the name of the allowance itself. Like you would have all heard about traveling allowance. Traveling allowance is given to meet the employment. That's an official allowance which is given. You also have heard something called as HRI, house rent allowance. There is an allowance which is given for the purpose of helping the employee to meet his house rent. So that is a personal allowance. Do you understand? So there's the specific expenditure which is given that can be for official purpose or it can be for personal purpose, right? Official or personal. The specific expenditure which we are talking about here, that can be official expenditure or personal expenditure. And there is no relation between expenditure and allowance. Meaning, employer will be giving you a fixed amount of traveling allowance, say 5,000. He gives you a fixed amount of traveling allowance like 5,000. The employer is not concerned as to whether you are you are spending, whether you are spending 10,000 or whether you are spending 8,000, he'll be giving you 5,000. You may travel by train, you may travel by car, you may travel by bus, you may travel by taking a taxi. Employer is never concerned about all these. He says, I will give you 5,000, you meet all the traveling expenses, whatever you want. You may save out of this. You need not spend the entire amount. You can travel by train, or you can take the public transport. So you can save out of the 5,000 which is given to you. He is never bothered about the actual expenditure which you have incurred. Okay, that's what I told you. All these are fixed as on the basis of an agreement that is entered into between the employer and the employee. Okay, so these are a few criteria about allowance. Allowance is always given in money. It is a fixed sum of money that is given periodically. I told you it can be given weekly, monthly, daily, and so on. The purpose of allowance is to meet a specific expenditure, which expenditure can be either official or personal, and there is no relation between expenditure and allowance. The employer may give you a medical allowance of 1,000 per month, fixed medical allowance of 1,000 per month. You may have not fallen sick. You may have not fallen ill during this year. Even then, the employer keeps on paying you a fixed medical allowance of 1,000. You might have purchased medicines for 2,000 rupees. Employer is never bothered about that. He will be again giving you a fixed allowance of only 1,000 rupees. Did you understand what is an allowance? Okay, now let us come to perquisite. That is the next term which we have explained there. Perquisite means personal benefit. Personal benefit. I am working in this organization, as a result of which the employer is giving me a lot of benefits. As long as I'm in this organization, I can enjoy all those benefits which are given by the employer. And that benefit which is given by the employer may be in cash or in kind. The benefit which is given by the employer may be in cash or in kind. Now, what are the cash benefits which are given by the employer? Cash benefits. Employer pays my domestic electricity bill. All my personal things are taken care of by the employer. Employer pays my domestic electricity bill. All my household expenses, that is taken care of. That can be in two ways. Paying the domestic electricity bill can be in two ways. Either employer pays directly to the electricity board. He goes and he pays directly to the electricity board. Or the employee incurs that expenditure and the employer reimburses. So either direct payment or reimbursement. Either way, that is a cash perquisite. Do you understand? Direct payment or reimbursement. Okay. So employer pays domestic electricity bill. As I told you, my personal expenses are being taken care of by the employer. It can be done in two ways. Either the employer pays direct to that outside agency, whatever, the electricity bill or my cooking gas bill or my domestic servants I have. Employer pays salary to all of them. So all my household expense. Or the employee will spend first and then the employer reimburses to the employee. My children's education fees, that is also being paid by the employer. It can be in so many ways. So it is a cash perquisite which is given by the employer. Then the next one is kind perquisite. Kind perquisite means employer gives me an accommodation. Employer gives me an accommodation. He gives me a house. He has given me a quarters. He's not paying me HRA. He's not paying me allowance. Instead, employer says that there is free quarters available. Or another thing is, instead of paying me traveling allowance, he offers me a motor car. He offers me a motor car. That is again a perquisite in kind. All right. Then instead of paying me a fixed medical allowance, employer says we have our own hospital. Own hospital. Employer's hospital. I can take any time. I can take free treatment there. Employer's hospital. So will be perquisite in kind. All these will be perquisite in kind. See, if it is a cash perquisite, it is easier to include that amount in your salary because just identify what is the expenditure incurred by the employer, directly take that amount in your total income, and that will form your total salary portion. But if it is a kind perquisite, we have to do certain steps. We have to convert this kind perquisite into cash. If he gives me an accommodation, we have to identify what is the money value of that accommodation. If he gives me a motor car, I have to identify what is the monetary value of that motor car. I have incurred, I have taken free treatment in my employer's hospital. How much is the employer spending for me? That is my benefit. So there are certain rules for conversion of these perquisites into money, which we have to study. There is a valuation rule, a specific rule in income tax, rule 3, which talks about all these valuation rules. And we have to go into each of these kind perquisite and identify what is its value in money. Okay. So these are the two things in our definition. There is allowance, there is perquisite. Anything over and above that, anything which is not allowance, which is not perquisite and given by the employer will be called as salary. See, one thing which you have to keep in mind here is only amount given by employer will be taxed under salary. Any amount not given by employer cannot be called as salary. Only amount given by employer will be taxed as salary. Okay. And whatever name you call it, even gift given by an employer, it is taxed under salary. It is not other sources. Gift given by employer is taxed as salary. So only amount paid by employer and all payments made by employer will be taxed as salary. Okay, so these are the there are three things: salary, allowance, perquisite. All three added together, we call it gross salary. From gross salary, there are three deductions. Deductions are under section 16. The first one is standard deduction. That is a fixed uniform deduction available to all employees. And the amount of deduction which is possible is 50,000. 50 is the amount of deduction which is possible. Apart from that, there are also deductions like entertainment allowance and professional tax. Okay, we'll see all that later. And after deducting all these, we arrive at taxable salary. Now, there are only three sections which cover salary: section 15, section 16, and section 17. But there are a lot of rules that govern provisions of salary. So simultaneously, we have to look into those rules, the relevant rules as well. So first of all, it is section 15, basis of charge. Any chapter, any head of income for that matter, we start with basis of charge. Basis of charge meaning, when will an income be charged under this head? When will an income be charged under this head? See, in order to charge an income under this head, either salary has to become due or salary has to be received. Salary has to become due or salary has to be received. In most of the cases, salary falls due on the last day of the same. April salary falls due on April 30th. May salary falls due on May 31st. June salary falls due on June 30th, and so on. Most of the cases. Okay. But in government employees, in case of government employees, salary falls due on the first of next month. Like salary of April does not become due on April 30th. Instead, it becomes due on May 1st. Doesn't make quite a difference. But even then, salary falls due only on the first of next month. In order to tax an income under this head, salary shall become due or it is received during this year. Meaning, salary, when we are talking about previous year 2023-24, assessment year 24-25, salary has to fall due between 1st April 23 and 31st March 24. 1st April 23 and 31st March 24, salary has to be either it should have fallen due or it should have been received during this year. All right. Otherwise, the salary will not be taxed during this year. Did you understand that? Okay. Now, as I told you earlier, when we compare a salaried person with a person earning business income. See, we are comparing two persons, a person having salary income and a person having business income. When we compare these two persons, what we identify is that a salaried person has got fewer deductions, only 3 deductions. But think about a person who is earning business income. What all deductions he is claiming in his P&L account? He is claiming deduction for salary. He is claiming deduction for the rent which he has paid. He is claiming deduction for depreciation, office expense, rate, transportation, electricity charges, and whatnot. Each and every item which you incur in your business, in your office, you claim it as deduction in your P&L account. And only you pay tax only on your net profit, right? Any head of income, whether it is salary or house property or business income, we pay taxes only on profits. We pay taxes only on profits. Now, how to arrive at profit? Profit is equal to receipt minus expenditure. Whatever head, receipt minus expenditure is your profit. You pay taxes only on a profit. But what all items can be claimed as expenditure, that is different for each and every head of income. That is different. Items which we can claim as expenditure in business cannot be claimed as deduction in salary. See, a person having income by way of business, he will be claiming deduction for depreciation. What depreciation does a salaried person has? He cannot claim any depreciation. Even if he has some sort of depreciation, I will not give you deduction. That is it. Income tax department doesn't permit that deductions. Income tax department permits only 3 types of deductions: standard deduction, entertainment elements, and professional tax. So that is that has been one worry for salaried classes. We have no deduction for any expenditure. To compensate that, the Act provides something else called as exemptions. Exemptions. There can be deduction and there can also be exemption. What is the difference? What is the difference between deduction and exemption? The amount for which you want to claim deduction, that is first included in your income. Amount for which you have to claim deduction is part of your income. Okay, you include that in your total income and then you deduct, then you subtract. That is what is called as deduction. Exemption is the amount for which you can claim exemption is not part of income. The amount for which you can claim exemption is not, it's not part of your income. It's never your income. The amount for which you can claim exemption. And income is exempt. Agricultural income is exempt. You don't include it in your gross total income. Is that not? But deduction is not like that. You first include it. See, LIC policy, you have paid insurance policy. You have to include that amount for which LIC policy is paid as part of your salary. You earn salary, and from that salary you pay LIC premium. So you have to include that in your salary and then claim as deduction, right? Second difference is deduction may exceed income. Deductions may exceed income. That is a reason by which you have losses. You have losses. Your P&L account will be in loss. Why? Your expenditure is more than in your income. If deductions cannot exceed income, no one in this part of India will be having losses. But that's not like that. You may have losses as well. Also, deductions may exceed income, but exemption cannot exceed. Exemption cannot exceed income. If you have agriculture income of 5 lakh, maximum what I can tell you, 5 lakh is not to be included in your income. The maximum exemption which I can give you is only 5 lakh. I cannot tell you that you need not include 6 lakh in your income. You cannot claim exemption for 6 lakh. You cannot, by claiming exemption, you never can have a loss. By enjoying the exemption, you can never have loss. You can reduce your income to 0. That's it. Okay, so these are the two differences between deductions and exemptions. So salaried class have fewer deductions. So in order to compensate that, we are giving more and more exemptions for the persons having salary income. Okay, we are giving more exemptions for salary class. So now let us see what are the exemptions that are available to salary class. There are, when we see that format, we have exemptions for salary. We have exemptions for allowance as well. Okay, we have exemption for salary. We have exemption for allowance as well. Exemption relating to salary is, there are 7 exemptions. 7 exemptions relating to salary and 3 exemptions relating to allowance. So altogether, we have to identify 10 exemptions that are applicable under this head. There are altogether 10 exemptions which are applicable under this head. 7 exemptions relate to salary and 3 exemptions relate to allowance. Let me list it down. What are the various exemptions relating to salary and what are the various exemptions relating to allowance? Exemptions relating to salary are gratuity, pension, base salary, retrenchment compensation, PRS compensation, then PF and superannuation fund. These are the 7 exemptions relating to salary: gratuity, pension, leave salary, retrenchment compensation, VRS compensation, PF, and superannuation. 7 exemptions, that is from 10 to 1013. There are 7 sections which discuss with exemptions relating to salary. And allowance, there are 3 exemptions. Allowance, there are 3 exemptions. They are HRA, special allowance, foreign allowance. See, what we have to identify from this is, if there is no exemption, that is fully taxable. If there is no exemption, then it is fully taxable. So anything which is received apart from the names which I have mentioned in the screen, anything which is received from the employer, apart from these 10 items which I have mentioned in the scheme, that will be fully taxable. Fully taxable. Items other than these 10 will be fully taxable when they fall under the head salary or under the type salary or under the subcategory elements. In order to claim an exemption, it has to be specifically mentioned. Specifically. Only when it's specifically mentioned, we can claim exemption. Any item other than these 10 items, 7 relating to salary and 3 relating to allowance, anything which is received other than these will be fully taxable. So let us see what are the exemptions. We'll go in order. First, we'll discuss with gratuity, then pension, then leave salary, then retrenchment compensation, VRS compensation, PF, and superannuation. We'll first go to gratuity. Gratuity. The provisions regarding gratuity are contained in Section 1010 of Income Tax Act. The exemptions relating to gratuity are contained in Section 1010 of Income Tax Act. See, gratuity may be received while in service. Very rare. Very rare if some gratuity is received while in service. Generally, gratuity is a retirement benefit. Okay, that is a retirement benefit. But if at all some employer pays you gratuity while in service, such gratuity received will be fully taxable. Gratuity received while in service is fully taxable. So the exemption which I am talking about under Section 1010 is only for that gratuity received at the time of termination of employment. Okay, the exemption which I am talking about now, it is only for gratuity which is received at the time of termination of employment. And the gratuity which is received at the time of termination We can claim exemption only in respect of that gratuity. Even for that gratuity, the exemption has to be classified into 3 different types of employees. The exemption is divided into 3 different categories, and these 3 different type of category have 3 different types of exemptions. Let us see what are the rules. Gratuity which is received by a government employee, that is fully exempt. Gratuity received by a government employee is fully exempt. There is no calculation required. There is no calculation required. That is fully exempt. A gratuity which is received by employee who is covered by Gratuity Act and who is outside Gratuity Act. Okay, Gratuity Act is applicable where an organization has more than 10 employees. In such cases, the employer has to definitely pay gratuity. Not only that, the amount of gratuity which has to be paid is amount which is fixed by the Gratuity Act. Minimum that amount has to be paid. So we'll see all those. But even then, you are an employee who is covered by Gratuity Act. And there is another organization which is outside Gratuity Act. There is a small organization which is in which there are no such minimum number of employees. Government employee has got full exemption. The entire amount of gratuity received will be fully exempt, whereas non-government employee, it is not fully exempt, it is only partially exempt, partially. And what is that partial exemption? We will see. Whether you are covered by Gratuity Act or not. Let us take an organization, an employee of BSNL. That will be definitely covered by Gratuity Act. And there is a private company where there are only 2 employees, 2 workers. And even then the employer is paying you gratuity, that person will come under the others category. Both BSNL employee and that private limited organization employee can claim exemption, but not fully. Only a part will be exempt, and see what is exempt. Okay. So the formula is given there. The formula is given there. Formula for claiming exemption for Gratuity Act and others, it is given there. Let us see what is the amount of exemption which is given. What is the amount of exemption which is given? Okay. What is the amount of exemption? Let me explain with an example. I think that will be quite easier then. Who has put in 30 years of service. 30 years of service. 30 years, and let us take 4 months in an organization. Okay, this period of service is 30 years and 4 months. And his salary at the time of retirement was 25,000 per month. His salary at the time of retirement was 25,000 per month. Now, what does the Gratuity Act say? What does the Gratuity Act says? A Gratuity Act says that for every completed year of service, all right, for every completed year of service, pay him 15 days salary. Pay him 15 days salary for every completed year of service. 1 year, give him 15 days. For 1 year he has worked, give him 15 days salary. That is the rule of Gratuity Act. That is a limit which is fixed by Gratuity Act. Now, another thing which is given by Gratuity Act is a month has only 26 working days maximum. A month has only 26 working days maximum, because definitely there will be 4 Sundays. So the 25,000 rupees salary which I'm giving you per month, that is not for 30 days. I'm giving this 25,000 per month for 26 working days. Okay, that is what the Act says. I'm giving you a salary of 25,000 per month, but that's not for your 30 days of service. It is only for 26 working days. I'm giving you 25,000. So let me ask you, how much is how much is your salary for 15 days then? How much is the salary for 15 days? 25,000 is for 26 working days. So how much is your salary for 15 working days? 26 days you are getting 25,000. So 15 days, how much will be a salary? 25,000 into 15 divided by 26. This is 15 days salary. I hope this is clear. This is 15 days salary. 15 days salary is equal to 15 by 26 into 25,000. For working here for 1 year, I have to give you 25,000 into 15 by 26. For 1 year, I have to give you 25,000 into 15 by 26. So for 30 years of your service, how much should I give? 25,000 into 15 by 26 into 30. This is the minimum calculation. This is the minimum amount which you have to pay under Gratuity Act. So minimum, you will be paid this much. Minimum, you will be paid this much. 4,32,692 is the minimum amount of gratuity which has to be paid under the Gratuity Act. So let us see the first step then. How that first step comes? 15 by 26 into 15 by 26 into last drawn salary into number of years. That is what we did there. See, we had also made similar calculation, 15 by 26 into 25,000 into number of years. This is how we have to calculate the first step. This is a minimum gratuity which has to be paid. Minimum. Employer, if he wants, he can pay a higher amount of gratuity. Did you understand the first calculation? So this is how we calculate first. 15 by 26 into last drawn salary into number of years. Okay. For seasonal industries, that is factories which don't work the whole year, there you might not be receiving salary for the whole year. So instead of 15 by 26, we use 7 by 26 for seasonal industries. Okay. So that is the first step. Second step, I'm calculating the exemption. So exemption is calculated in 3 steps, 3 steps. Exemption is calculated in 3 steps. And the least of three of this, whichever is least is exempt. The first step is what we discussed now, 15 by 26 into 25,000 into 30. Second is, there is a maximum limit which is fixed by government. Maximum limit which is fixed by government, which is equal to 20 lakhs. 20 lakhs. During lifetime, a person can claim exemption only for 20 lakhs during his entire lifetime, no matter in how many years. It may be spread over a number of years, but the total exemption in your lifetime cannot exceed 20 lakhs. And the last amount is actually received. Compare with the amount which is actually received from your employer. Let us take an employer, he has given me 6 lakh, even though the minimum which is required by the Gratuity Act was 4,32,000. My employer being lenient, being broad-minded, he paid me 6 lakh as gratuity. Now let us see how much is exempt. How much is exempt? The least of these 3 is exempt. Least of these 3, which means 4,32,000 is exempt. So how much is taxable gratuity? Taxable gratuity is gratuity received 6 lakh. From that, we can claim deduction for 4,32,000. It's not deduction, sorry, exemption. We can claim exemption for 4,32,000. So 1,67,308 is the taxable gratuity. Even though you have received 6 lakh, you need not include 6 lakh in your total salary income. You need to include only 1,67,308 in your total income. So this is how we calculate exemption for gratuity. This is how we calculate exemption for gratuity. 15 by 26 into last drawn salary into number of years. Okay, and the 20 lakh and actually received. Next category. The smaller category which I was talking about. that organization which has only 2 employees. I'm not covered by gratuity act in that case, but even then, the employer is giving you gratuity. In that case, what is the difference? There, instead of 15 by 26, we use 15 by 30s. When you tell a common man a month, give him 15 days salary, a common man usually understands a month as 30 days, right? So he will calculate by taking 15 by 30. 15 by 30. Next step is you take average salary. In Gratuity Act, it was last drawn salary. Here it is average salary. And then again, number of years. The calculation is almost same, but there are differences as well. We will see the differences. So 15 by 30 into average salary into number of years. Then there is a maximum limit of 20 lakh and actually the same. So this example, again this example, if it had been others, how will our calculation be like? If it is others, other category. 15 by 30 into 25,000 into 30. Slight difference. In that case, the first step will be like how should that come to 25,000 into 15. 30 and 30 will cut down. So 3 lakh 75. 3 lakh 75, 20 lakh 6 lakh. Whichever list is exempt, in that case, 3 lakh 75 will be exempt. Okay, this is the difference in calculation between Gratuity Act and others. Right? So, one more point which I have to explain here is, we were talking about that lifetime exemption of 20 lakh, right? Lifetime exemption of 20 lakh. We can claim a lifetime exemption of 20 lakhs. Now, what does that mean? Lifetime exemption is 20 lakh. What do you mean by that? This means that the person in his entire lifetime, he can enjoy an exemption of 20 lakh. Meaning, suppose I have retired from A Limited in 2014-15. I retired from A Limited in 2014-15. Received gratuity of 6 lakh. And in that year, in 2014-15, I claimed exemption of 5 lakh. In 2014-15, I claimed exemption of 5 lakh. Gratuity received is 6 lakh, of which I claimed exemption of 5 lakh. Okay. Out of the 20 lakh, I have already claimed exemption for 5 lakh. So, if I retire from B Limited in 2023-24, my maximum limit will not be 20. Instead, my maximum limit would be only 15 lakh. I have already enjoyed exemption of 5 lakh. So the limit remaining now is only 15 lakh. So when you write down in 2023-24, all these formula, here the maximum limit you cannot write as 20 lakh in 2023-24. You should write only 15 lakh. That is the meaning of this lifetime limit. Lifetime exemption is 20 lakh. Okay. Let's see. What is the difference between Gratuity Act and others? Gratuity Act and others, when we do the calculations, what is the difference? Two differences we have already seen. One is a difference in the ratio. In one case, we had taken the ratio as 15 by 26. In the second case, it's not 15 by 26. It is 15 by 30 or simply 1 by 2. That is the first difference between Gratuity Act and others. 15 by 26, 15 by 30. Second difference is for how many years you have to pay him gratuity. Gratuity Act says that you have to take completed years and also you have to take part of the year in excess of 6 months. Meaning, if you have worked here for 30 years and 8 months, if you have worked in this organization for 30 years and 8 months, I will give you gratuity for 31 years. Okay, part of the year in excess of 6 months is treated as 1 year. So 30 years and 8 months, I'll give you gratuity for 31 years. All right. 30 years and 4 months, I'll give you gratuity only for 30 years. But other organizations, we take only completed year. Part of the year is ignored. You work here for 30 years and 11 months. Even then, I'll give you gratuity only for 30 years. You work here for 30 years and 11 months. Even then, gratuity is given only for 30 years. Okay. So that is the second difference. Third difference. Which month's salary is to be considered? Which month's salary? We have seen that. Under Gratuity Act, we look into the last drawn salary. Last drawn salary means salary for the month of retirement. Okay, salary for the month of retirement. That is what we look into. Whereas in others, we take average salary. Average. And average is taken for the, how do we calculate average? How do we calculate average? The average is taken on the basis of 10 months salary. Which 10 months salary? 10 months salary preceding the month of retirement. Let me explain that. A person retires in May. May. His month of retirement is May. So take 10 months salary ending up to 10 months salary ending up to April. 10 months salary ending up to April. Month of retirement, take the 10 months preceding that. Whether you retire on May 1st or May 15th or May 30th or May 31st, you have to take salary for the last 10 months. Last 10 months preceding the month of retirement, before the month of retirement. So it is 10 months up to April. Add salary for the 10 months up to April. Divide by 10, you get 1 month's average salary. That is how you take salary. But in case of Gratuity Act, you take the salary for the month of May. That is your last drawn salary. Okay, you are taking salary for the month of May. One more thing, if there is no difference in salary in the last 10 months, there is no point in calculating average. When do you calculate average? When do I calculate average for marks of my students? See, the marks of each and every individual student varies. One gets 60, other gets 62, other gets 64. Then I have to add all these 60 plus 62 plus 64 divided by number of students will give me average. On the other hand, all my students get 65 marks. Each and every student gets 65 marks. Then average is 65. There is no point in calculating the average. So the same way, if your salary changes, varies in the last 10 months, you have to calculate average. Otherwise, there is no point, there is no need in calculating average salary. So that was the third point. Which month's salary is to be taken? In case of Gratuity Act, a person retiring in May, you will calculate gratuity on the basis of salary for the month of May. The person retires in May and you are falling under other category, you will calculate 15 by 30 on the basis of average salary for the 10 months ending up to April. Okay. Now, fourth point. What do you mean by salary here? What are items? 15 by 26 on which amount you have to apply? Which amount you have to apply? 15 by 26. Salary means it is basic salary plus DA. DA always. Whether it forms part of retirement benefits, you would have heard about all these terms, right? The forming part of salary or forming part of terms of employment, forming part of retirement benefits, forming part of employment, all these meaning the same thing. Basic salary plus DA always. DA has to be always taken. Basic salary plus DA, that into 15 by 26. Okay. Other category, salary means basic salary plus DA provided by terms of employment plus. Only DA is provided by terms of employment. Only BA is forming part of salary. Only DA is forming part of retirement benefits. We have to consider that DA plus commission paid on fixed percentage of turnover achieved by employee. So add all these three things together for the last 10 months. Add basic salary for the last 10 months. Add DA forming part of retirement benefits for the last 10 months. Add commission paid on percentage of turnover for the last 3 months. Add these three items, divide by 10, you get 1 month average. 1 month average into 15 by 30 into number of years, you will get the exemption first calculation. Okay. See, the last definition which I had told you, basic salary plus DA provided by terms of employment plus commission. That is the commonest of the definition which we use in most of the exemption calculations. In most of the exemption calculations, this is a definition which we use. Three cases we follow a different, we follow a different definition for salary. One case we have already seen, Gratuity Act. Gratuity Act, we don't follow this. Gratuity Act, their salary means basic salary plus DA. Okay. So, these are the cases where you can claim exemption. So let me repeat. Exemption under section 1010 for gratuity. Gratuity may be received by in service or it may be received by on termination. The termination can be divided into three types: government employee, employee covered by Gratuity Act and others. Government employee fully exempt, Gratuity Act and others, we have to make a calculation, list of three calculations, whichever is least is exempt. And the exemption is calculated as follows. Gratuity Act 15 by 26 into last round salary into number of years. 15 by 30 into average salary into number of years. 20 lakh, actually received. Differences between Gratuity Act and others are: one is regarding ratio, 15 by 26 and 15 by 30. Second is regarding the number of years, completed year and part of the year in excess of 6 months. Others we take only completed years. Each month salary, last round salary. And the second case is average salary for the last 10 months. Last 10 months means before the month of retirement. What is definition of salary? Basic salary plus DA. Here we follow a common definition. Basic salary plus DA provided by terms of employment plus commission paid on turnover. That was the first exemption. The second exemption is in relation to pension. The exemption regarding pension is given under section 1010A. Exemption regarding pension is given under section 1010A. What is that? Pension can be divided into two types. Pension can be divided into two types. One is the uncommuted pension. Uncommuted pension. That is, uncommuted pension means that pension which normally comes to our mind whenever we talk about the term pension. That is a monthly payment which the employer pays after retirement. That is the monthly payment, periodic payment, which the employer pays is called as uncommuted pension. See, it's not uncomputed, double M, UNCU double M, uncomputed pension. That is a monthly pension. And there is another pension called as commuted pension. Commuted. Commuted means that pension which is given in lump sum. In lump sum, a huge amount which is given in place of future monthly pensions. You are asking your employer to give you pension in lump sum. That is, you don't need pension in installments, monthly pensions. In place of such monthly pension, you are asking your employer to give a lump sum amount. And that lump sum received is called as commuted pension. See, when you receive that lump sum pension, then there will be no monthly pensions thereafter. Thereafter, there will be no monthly pensions because you have already received it in advance. Pension received in advance in place of monthly pension is called as commuted pension. Okay. That pension which is given, that will be fully taxable. That will be fully taxable for both government employee and non-government employee. Okay. That will be fully taxable for both government employee and non-government employee. So whatever exemptions we are talking about here, that relates only to commuted pension, the lump sum pension which we are receiving. Okay, the monthly pensions are fully taxable, whether you are a government employee or a non-government employee. The 1010A exemption relates only to commuted pension, commuted lump sum pension which is received. Now that again, commuted pension when we are receiving, that again will be divided into two categories, government employee, non-government employee. Government employee, there is no need for calculation as we discussed in the case of gratuity. Here also there is 100% exemption for 100% exemption. Government employee, it is fully exempt. Commuted pension received is fully exempt. When a non-government employee receives commuted pension, that can be divided into two portions. A non-government employee, when he receives commuted pension, I will ask you another question before I talk about the exemption. I will ask you whether you have received gratuity at the time of retirement. We all know pension is received after retirement. So I will ask you at the time of retirement whether you were paid gratuity. And if you say yes, I will say that, okay, in that case, you have already claimed exemption for gratuity, right? So here I will give you only a lower amount of exemption, which is 1/3. On the other hand, your employer is that person who has not paid you gratuity at the time of retirement. You have not claimed exemption for gratuity. So your pension exemption will be higher of 1/2. Okay? You can remember by applying that logic. If gratuity is received, you have already claimed exemption for gratuity. So here the exemption will be lower, like 1/3. If you have not received gratuity, for pension, I will give you higher exemption. Since you have not claimed exemption for gratuity, here you can claim higher exemption of 1/2. And 1/3 and 1/2 of what? 1/3 and 1/2 of 100% pension. Okay, 1/3 and 1/2 of 100% pension. That is the amount of exemption which you can claim. Again, I will explain with the help of an example. Let me explain. Let's take an employee who retired on 31st May 2023. Okay. He is paid gratuity. Gratuity received at the time of retirement. Gratuity received at the time of retirement. Now his pension was originally fixed at 15,000 per month. His pension was originally fixed at 15,000 per month. On 1st February 2024, what he did is he commuted. Okay, he asked his employer to give him a lump sum pension, and he commuted only 33.33% of his pension, that is 1/3, and he received amount 1,50,000. Okay. Commuted around 1,50,000, and 1,50,000 was the pension which he had received. Or let me make it 3 lakh. Okay. 1 minute. Let's make it 2 lakh. He received make a calculation so that there are no decimals in the question. He commuted 40% of his pension, his total pension. He commuted only 40% of his total pension, and he received 2 lakhs. he received 2 lakh. Now let us calculate how much is his exemption. How much is his exemption? He is not a government employee. So there are 2 types of pensions which he has received. One is commuted pension, and the other one is the monthly pension, or it is also called as uncommuted pension. Monthly pension, which is also called as uncommuted pension. Okay. How much did he receive his monthly commuted pension as? 2 lakh is the total commuted pension which he has received. All right. 2 lakh is the total commuted pension which he has received. Now let us see what is exempt under section 1010A. What is exempt under section 1010A? All right. What is his exemption out of this 2 lakh? How much can he claim exemption out of this 2 lakh? What we will do is, we will find out how much did he commute now? He commuted 40%. Is it not? 40% he commuted for 40% for 2 lakh. When he commuted 40%, he received 2 lakh. Okay. So what we have to see is, what does that exemption say? What does that rule say? Let us read the rule first once again. He is receiving gratuity, so his exemption would be 1/3 of 100% pension. So let me write it down. 1/3 of 100% pension. That is his exemption. It's not 1/3 of 2 lakh that is exempt. It's not 1/3 of 2 lakh that is exempt. It is 1/3 of 100% pension, meaning if you had received the entire pension computed now itself, how much would you have received? Normally, nobody commutes 100% pension, because if you commute 100% pension from the next month onwards, there is no pension which will be received by you. Okay. The whole idea regarding this pension is to get a social security. Even if you don't have an employment tomorrow, you are receiving some monthly amount. That is the whole idea about pension. Now, if you commute the entire 40%, entire 100% now itself, then what is the point in giving you pension monthly? You are not going to receive anything. So the pension is like you have to receive something monthly even though you don't have any job. So nobody commutes 100% pension because everybody needs some monthly security. So a person will be commuting on a certain percentage of your total pension depending upon your emergency for funds. So let us come to this. I commuted 40% and I got 2 lakh. How much would I have received if I had commuted the entire pension? If I had commuted the entire pension, normally I don't, but if I had commuted 100% pension, how much would I have received? 2 lakh into 40 divided by 100. 2 lakh divided by 40 into 100. 2 lakh divided by 40 into 100. How much would I have received? 2 lakh divided by 40 into 100 means I would have received 5 lakh. So 100% pension is equal to 5 lakh. Okay. 100% pension is equal to 5 lakh. So our exemption will be 1/3 of 5 lakh. 1/3 of 5 lakh. This will be exempt. So taxable commuted pension will be 2 lakh minus 1,66,667. This will be your calculation. I hope this is understood. So, first of all, find out how much you would have received had you commuted 100% pension. If you had commuted the entire pension, how much would you have received? That into 1/3 will be the amount of exemption. Okay. So 33,333 would be the amount of exemption. This is a commuted pension which we are talking about. It's not over. Apart from this, you are also receiving monthly pensions. Monthly pensions received are fully taxable. Monthly pension received is fully taxable. So let us see how much is the monthly pension you receive. When did you retire from your service? You retired on 31st July 23. You retired on 31st July 23. Okay, in the example which I had given you, you had retired on 31st July. So you will start receiving pension from August onwards. Let us count August, September, October, November, December, January. 6 months. These are the 6 months. August, September, October, November, December, January. These 6 months, you have received a pension of 15,000 into 6. That is 90,000. Okay. Your pension fixed was 15,000. You received that. But on February 1st, you went to the employer and already took your 40%. All the 40% have been already collected by you on 1st February. All the future 40% have been already collected by you on 1st February. So February and March, these are only the 2 months which are remaining in this financial year. February and March, the employer will not give you 50 plus 15,000. Employer will not give you 15,000. How much will the employer give you? He will give you only 15,000 into 60% because you have already collected all the 40% on 1st February. All the future 40,000s now come to 2 lakh. Present value of the future annuity, we can calculate applying all those. That is 15,000 into 40%. How much is 15,000 into 40%? 15,000 into 40% is 6,000, right? Thousand. The present value of all future 6,000 is 2 lakh. Present value of future 6,000s is equal to 2 lakh. All the future 6,000 added together. Now we have already collected it in the form of 2 lakh. So from now on, from February onwards, February end onwards, I won't give you that 6,000. I'll give you only the remaining. That is 15,000 into 60%. That into 2 months. 15,000 into 60%. That comes to 9,000. 9,000 into 2 will be 18,000. So total amount is 1,08,000. Total amount is 1,08,000. So this is how your total taxable pension will come. This is your total taxable pension. Taxable pension. Okay, if you commute 40%, after that your monthly pension will be only 60%. If you commute 60%, after that your monthly pension will be only 40%. If you commute 70%, your monthly pension after that will be only 30%, and so on. This is how we calculate exemption for pension. Exemption is there only for commuted pension. There is no exemption for uncommuted pension. That is fully taxable. Okay, so pension is over. Pension exemption is over. Now we come to the next item. Salary. The next exemption. Leave salary. Exemption regarding leave salary is given under section 1010 AA. Section 1010 AA. 1010 was gratuity, 1010 A was pension, 1010 AA is leave salary. Okay. Exemption regarding leave. How do we calculate exemption for leave salary? All right. So that is our next calculation. Exemption for leave salary. Exemption for leave salary. Leave salary exemption can be divided into 2 types. That is, leave salary may be received while in service or it may be received while in termination of the employment. Okay, it may be received while in service or it can be received while on termination of retirement, termination of your employment. As we discussed earlier, leave salary which is received while in service and is fully taxable, as in the case of gratuity as well. Leave salary means the eligible leave which is given by the employer is not encashed by you. Okay, the eligible leave which was given by the employer is not availed by you. It is not availed by you. Not encashed. It is not availed by you. Okay, employer is telling that you can take a leave of 45 days during a year. You have not taken leave for the entire 45 days. You took leave only for 30 days. You have a leave of 15 days standing to your credit. That 15 days will be carried forward to the next year. So next year you can take 45 plus 15, which is equal to 60 days. Again, you took only 20 days leave in the next year. You have a credit of 40. Again, carry forward. And that way you are accumulating all your leave. And leave accumulated is surrendered to the employer, and you are taking cash equal to that. You have 3 months leave standing to credit. You surrender 3 months leave and take cash for 3 months. You have 5 months leave to your credit. You surrender 5 months leave and take cash to that. And that is what is called as leave salary. You may encash your leave at any point of time, but while in service, if you encash it, that will be fully taxable. So when you encash it on retirement, you have to again divide into 2 categories: government employee, non-government employee. Government employee, no need for calculation, it is fully exempt. Non-government employee, it is exempt to the least of the following. There are 4 calculations, whichever is least is exempt. First point is leave standing to credit as per income tax rules. Leave standing to credit as per income tax rules. See, as per income tax rule, you can claim a credit of only maximum 30 days. Maximum 30 days. In a year, you can take a leave of only 30 days. That is what the income tax rules say. So on that basis, see how much is leave standing to credit. That into average salary. That is the first calculation. 2, 10 into average salary. 3, maximum limit of 25 lakhs. And there is actual leave salary received. So here the limit is fixed not just in terms of rupees, it is also fixed in terms of month. The maximum encashment, maximum exemption can be only 10 into average salary, means 10 months salary, 10 month. So leave standing to credit as per income tax rule, even if it is 11, the first step will be 11 into average salary, 11 months into average salary. Second step is 10 into average salary. So the lease will be 10 into average salary. So maximum you can encash, you can claim exemption only for a leave salary of 10 months. That is what that says. Not only that, the amount cannot exceed 25 lakh. Okay, 10 months salary and subject to a limit of 25 lakh as well. Now, salary means the common definition: basic salary plus DA provided by terms of employment plus commission paid on fixed percentage of turnover achieved by the employee. Okay, basic salary plus DA provided by terms of employment plus commission paid on fixed percentage of turnover achieved by the employee. And average is calculated on the basis of salary for 10 months preceding the retirement. When we discussed gratuity, we had also calculated average salary there, but there I had used the term preceding the month of retirement. Preceding the month of retirement was a term which I had used in gratuity. Here I am using the word preceding the retirement. What does it mean? What is the difference? Let me go back to the earlier example which I had given you. Somewhere here I told you that if May is the month of retirement, you have to calculate salary for 10 months ending up to April. That was in gratuity. But here in leave salary, if you are retiring in May, you have to calculate average of salary for the 10 months ending up to May, not up to April. You have to take those 10 months ending up to May itself, because your date of retirement is May. So you have to take 10 months up to May. Okay, so each section is different. Please keep in mind all those differences. It is preceding the retirement. The retirement means the date of retirement. So if you retire on May 31st, in leave salary, you calculate average up to May 31st. Whereas in gratuity, if you retire in May, you take 10 months up to April. So that is regarding leave salary. Then, next is, here also the limit is 25 lakh. 25 lakh is a lifetime limit, meaning if you have claimed exemption in some earlier year, the total amount of exemption which you can enjoy will be reduced in a subsequent year. Out of 25 lakh, I have already claimed exemption for 3 lakh in an earlier year. This year, my maximum limit will not be 25, it will be only 22. Similar. Now let us come to the fourth exemption. Fourth exemption in respect of gratuity. Fourth exemption in respect of gratuity. Fourth exemption in respect of salary, sorry. Fourth exemption in respect of salary. Fourth exemption. That is 1010B. 1010B is in relation to retrenchment compensation. Retrenchment compensation, that is all given under Industrial Disputes Act 1947. So the first step is you have to calculate the exemption under section 25B. 25B of Industrial Disputes Act 1947. There is amount calculated under that act. It is almost similar to gratuity, that 15/26 method. That is almost similar to that. And then there is a maximum limit of 5 lakh. And lastly, you have to take the actual salary receipt. Whichever is least will be exempt. Okay. Then there is VRS compensation, 1010C. VRS means Voluntary Retirement Scheme. That is a full form of VRS, Voluntary Retirement Scheme. We know that all employers, they have fixed an age for retirement, but you may retire voluntarily before attaining that age of retirement, and then you get an exemption that is called as VRS. So VRS exemption is available only if certain conditions are satisfied. Like the condition, one of the conditions is that you have to attain an age of 40 years, or you should have rendered a service of 10 years. Some conditions are fixed there. And all those, the objective of VRS is to reduce the employee strength. So the vacancy created by VRS shall never be filled up. Such conditions are there. Anyway, if all those conditions are satisfied, the amount of exemption which you receive, the amount of compensation which you receive will be exempt, subject to 3 steps. Again, the 3 steps, almost in all the cases, we are calculating exemption in 3 steps. Here also there are 3 steps. The first case, but in the first case, there are 2 calculations. Choose higher in the first step. The higher amount in the first step. Compare that first step with second and third. There you can choose whichever is lower. Okay. So higher in the first step, that higher amount, 2 and 3, take whichever is lower. So what does the first step say? First step says that for every completed year of service, you are given 3 months salary. See, gratuity was paid only for 15 days for every completed year of service. Here, I'm giving you VRS compensation for 3 months. 3 months salary is your compensation for 1 year of service. Last drawn salary into, last drawn monthly salary, of course. Last drawn salary into 3 into completed year of service. Okay, last drawn salary into 3 into completed year of service. Second calculation, the first step is last drawn salary into remaining month of service. What does it mean? If you had not taken VRS, how much would be your, if you had not taken VRS, how much would be your future salary? That entire future salary. Entire future salary if you had not taken VRS. That is what step B says. Last drawn salary into remaining month of service. Make these 2 calculations. Choose whichever is higher. That higher amount is combined with maximum limit of 5 lakh and also actually the same. Whichever is least will be exempt. Okay, so this is the exemption for VRS. Salary again here means the common definition. Basic salary plus DA provided by terms of employment plus commission. Now exemption for VRS, unlike in other cases, this is once in a year exemption. Once in a year exemption. In case of gratuity and leave salary, I told you that you can claim exemption for any number of years. Okay, you can claim exemption for any number of years, but the maximum exemption can be only 25 lakh. Meaning if you had claimed exemption last year for 3 lakhs, this year you can claim 22 lakh. That was the rule for gratuity and leave salary. But here it says this exemption can be claimed only once in your lifetime. Only in one assessment year. What does that mean? I took VRS during this year, assessment year 24-25, I took VRS from BSNL. When I made all these 3 calculations, the least amount I got as 3 lakh. 3 lakh is the least amount I got. Okay, so I claimed exemption for 3 lakh. This year I have claimed exemption for VRS at 3 lakh. See, the maximum limit fixed here is 5 lakh, which means I have a balance of maximum limit which is pending. But even then, I cannot claim that balance 2 lakh exemption in any other assessment year. I hope that is understood. Okay, this is once in a lifetime exemption. Exemption is available only once in a lifetime. All other exemptions, I told the limit was for lifetime. So you can claim it in various years, but all added together, that limit cannot exceed that limit. Here, you can only claim once in a year, once in your life, once in your life. Okay. That was VRS compensation. Relief we'll be discussing towards the end of this chapter. Just keep in mind, if you're claiming some relief for VRS compensation, then there is no exemption under 1010C. You'll see the relief, what is relief towards the end of this chapter. The 6th exemption in respect of salaries for gratuity, PF. The 6th exemption for salary is in relation to PF. PF can be of 4 types. The SPF, Statutory Provident Fund, or the Government Provident Fund, as the name denotes, that is for government employees. Recognized Provident Fund, that is employees who are covered under the Employees Provident Fund Act and all. Then there is a URPF, Unrecognized Provident Fund, not set up under any act, and the Public Provident Fund, wherein any member of the public can be a member. Anybody. Generally, PF is an arrangement between employer and employee, but PPF is an arrangement which can be opened by any person. I cannot, for example, since I'm self-employed, see the professionals, they are all self-employed. I don't have an RPF because I'm not an employee. I'm not an employee anywhere. I cannot have an RPF, but I can become a member of Public Provident Fund. Okay, how does the PF operate? In a PF, there will be employer's contribution as well as employees' contribution. Employer's contribution as well as employees' contribution. Every year, employer will take a certain amount from his pocket. He will deduct an amount from employee's salary. Both added together, he will go and deposit in PF office. Okay, amount taken, let us take 1,500 taken from employer's pocket, 1,200 deducted from employee's salary. I just take 2 different amounts for you to understand. 1,500 from employer's pocket, 1,200 from employee's salary. Both added together, 2,700, he will deposit in PF office in employee's account. 2,700 will get accumulated. Every month, there is 2,700 going into that PF account. And you also get interest from that. Every year, interest also accumulates. That also gets credited in your account. At the end of your service, at the time of retirement, you can withdraw that lump sum amount. So, without your knowledge, you are getting a certain amount as savings. By the time you retire, you will have a huge amount of savings in your PF office. You can take it home. So there are 4 components here. 4 components. There is employer's contribution, employees' contribution, interest on employer's contribution, and interest on employees' contribution as well. And finally, there is a lump sum. All these 4 added together, you get the lump sum. So what I'm concerned about here is whether the amount of 1,500 which the employer has contributed to my account every year, whether it has to be added to my salary income. Anything given by your employer has to be added to my income. So whether that has to be added to my income, that is my concern number 1. That is my first concern. Second concern, the employee has not received that 1,200. The amount which was deducted, his basic salary is 1 lakh and 1,200 was deducted from his basic salary. So he could not take 1 lakh home. His take-home salary was only 1 lakh minus 1,200. So the second point which we may always doubt is whether that 1,200 can be deducted from 1 lakh. For the amount she has not received, can he claim any deductions? That is the second point, which I have to answer from the point of view of taxation. Third point, every year I get interest in the account, whether that interest is to be taxed. And the last point, the lump sum received at the time of retirement, a huge amount, maybe 4 lakh got accumulated by the time I retired, and whether 4 lakh I took home at the time of retirement, whether it is taxable at the time of retirement. Let's answer all these questions with this table. Okay. First one is, I'm talking about government employees. So without saying, they get the maximum advantages. Let us see what are the advantages which they enjoy from taxation point. Employer's contribution is exempt. Okay. Employer's contribution, the amount of 1,500 which the employer has contributed to the employee's account, that is not his taxable income. That is exempt. Need not be taken. Okay. The amount which has been deducted from employee's salary, 1,200 was deducted from employee's salary. That can be deducted, but not under the head salary. It is not deducted under the head salary. Instead, it is deducted from gross total income. It is allowed as deduction under 80C. Fair enough. That's not a point. I need to get some deduction somewhere. It's not compulsory that I have to claim it under the. Anyway, department allows you to deduct it from 80C. Income Tax Act permits you to deduct it from 80C. Gross total income, you can claim 80C deduction. Gross total income, you can claim 80C deduction. Not from salary. When you calculate salary, you have to take the entire basic salary of 1 lakh, add all other 4x, arrive at gross total income, then deduct 1,200. Fine. Third point, that interest every year, which is getting credited in the account, is that taxable? No, that is exempt as well. That is also exempt. Last point, lump sum received at the time of termination or retirement, is that taxable? No, that is also exempt. Maximum benefit. All maximum possible benefits are given in this case. Okay. When we talk of an RPF, that is recognized provident fund employee. Let us take an employee of BSNL. He is not a government employee, an employee of BSNL. BSNL employee is covered by RPF. What are the benefits which are available? As always, which we had discussed, these non-government employees, they enjoy benefits, but up to an extent, up to a certain limit, up to a certain restrictions. Subject to certain restrictions, non-government employees, they enjoy benefits. So let us see how much regarding employer's contribution. Employer's contribution, it is exempt up to 12% of salary. See, my salary is, let's take 10,000. If my salary is 10,000, my exemption is 12% of 10,000, that is 1,200. Employer is contributing 1,500. So 300 will be taxable as my salary income. Do you understand? If it is a government employee, 1,500 fully exempt. But for a non-government employee falling under RPF, exemption is only up to 12% of salary. So your salary is 10,000, employer contributed 1,500, exemption is only up to 1,200, 300 is taxable as your income. Salary means again, common definition. Basic salary plus DA provided by terms of employment. All this into plus commission. All this into 12% is exempt. ATC deduction available? Yes. No difference between government employee and a BSNL employee. How about interest? Interest is exempt, but there is again a restriction. Interest is exempt only up to 9.5%. Interest is exempt only up to 9.5%. Meaning, if I'm getting interest at the rate of 12%, 2.5% will be taxable. Amount in excess of 9.5 is 2.5. 2.5 will be taxable. Okay. And lastly, how about exemption relating to lump sum amount? Lump sum is also exempt, but again subject to certain conditions. Let us see what are those conditions. Lump sum is also exempt, but there are certain conditions. What are those conditions? First condition is, you are getting lump sum from RPF. Let us take 4 lakh you are receiving. Of that 4 lakh, if you want to claim exemption for 4 lakh, you should have rendered a service there for a continuous period of 5 years. You should have worked there with that employee, with that employer. You should have worked with that employer for a period of 5 years. Okay. Point number B, or you could not render that service of 5 years. That was because of reasons beyond your control. You worked there for only 3 years. You resigned after that, but the reason was not your fault. Like you fell ill because of your ill health. You fell ill, and hence it was not possible for you to continue your employment. So you retired from there. You resigned from there. You can claim exemption. Or the employer has stopped his business. 3 years after you joining, The employer stopped his business. That is not employee's fault. So again, he can claim exemption. Third case, you retired, you resigned from an employer after 2 years of service. After resigning from employer 1, you joined employer 2. You joined B Limited. And when you joined B Limited, you asked the PF office to transfer all your money lying under employer A to employer B. Anyway, you'll be continuing your PF office with PF account with employer B as well. So you did not take PF home. You did not take the PF home. Instead, it was transferred from one employer to another employer. Then also, the exemption can be enjoyed. Meaning, the amount will be taxable only if you withdraw the money within a period of 5 years. Withdraw the money and take it home within a period of 5 years. Okay. So that was regarding RPF. So as I told you, these RPF employees, that is non-government employees, they enjoy all the exemptions, but subject to certain conditions, subject to certain limits, subject to certain restrictions. So employer's contribution is exempt only up to 12%. Employer's contribution. Employee's contribution, ATC deduction is available. Interest is exempt only up to 9.5%. Lump sum is exempt subject to condition that you have rendered a service of 5 years. Or else you could not render that service for reasons beyond your control. Or else this amount has not been withdrawn. Instead, it is transferred to your account, the employee's own account with another employer. Okay. URPF means, as the name specifies, there is an unrecognized provident fund. Unrecognized, that is not mentioned anywhere. It's not recognized anywhere. It's not statutory. It's not statutory. It's not compulsory. RPF is a compulsory account. URPF is not a compulsory account. So if a person maintains that some type of unstatutory, non-statutory funds, unrecognized funds, which is not anywhere approved, then there are no tax benefits. There are no tax benefits if you start a URPF. So let us see what are the tax treatments. Employer's contribution. It's not treated as income in the year in which employer contributes. See, I have not used the word exempt. I have not used the word exempt. I only have mentioned that it is not treated as income now in the year in which employer contributes. At that point of time, it's not income. Okay. Deduction under ATC, not available. Then claim deduction under ATC only if you make contributions to the funds which the government has recognized, which the government has made compulsory, which the government has made statutory. Make contributions to those funds. I will give you deduction. But if you make contribution to these unrecognized funds and all, I cannot claim you deduction for that. So there is no deduction is available for deduction under ATC if you contribute to URPF. Interest credited to provident fund, not treated as income now. Not treated as income in the year in which interest is credited. But when will all those be treated as income? When will all those be treated as income? It will all be treated as income in the year in which you withdraw the lump sum. Everything together as a whole will be taxed in the year in which you withdraw the lump sum amount. So when you withdraw the lump sum amount from PF at the time of retirement, it's a huge sum. Say you receive 6 lakh at the time of retirement, and you get 6 lakh from URPF. Okay, this 6 lakh has got 4 components, as I told you earlier: employer's contribution, interest on employer's contribution, employee's contribution, interest on employee's contribution. The amount which you contributed, you get it back. Employee's contribution, you receive back. There is no profit involved in that. Here we pay tax only for profits, is it not? So the employee's contribution, which you have contributed and which you yourself has received back, that is not taxable. That is exempt. But when you contributed 2,20,000, you would have received back 2,60,000, meaning that 40,000 would be interest on employees' contribution. That is taxable as other sources. Interest on employees' contribution is taxable as other sources. balance. Balance is employer's contribution and interest on employer's contribution. That is taxable as salary. Okay. Employer's contribution and interest on employer's contribution is taxable as salary. That is regarding URPF. Okay. Employer's contribution is not treated as income. ATC deduction is not available for employees' contribution. Interest is not treated as income now, but everything together, we tax it at the time of receiving the lump sum amount. Now, the last type of provident fund is PPF, Public Provident Fund. As the name denotes, any member of the public can join this provident fund, but there is no employer's contribution there. So actually, I'm not talking about employer's contribution. Employer does not contribute to a public provident fund. This is one which I have opened at my wish. Nobody has compelled me to open this provident fund. So I went to some nationalized bank. I opened a PF account, just like I open an SV account, I open a PF account. I myself contribute. There is no employer to contribute. Okay, so there is no employer's contribution. For my contribution, I can claim ATC deduction. Interest is exempt. Lump sum received is also exempt. So there is an advantage in opening a PF account rather than an FD account, because FD account, if you contribute, you cannot claim deduction under ATC. Interest received on FD account will be taxable under other sources, but interest received from PF is exempt. So that is an advantage if you open a PF instead of FD. So these are the 4 types of PFs account. Okay, SPF, full exemption, maximum benefit. RPF, everything limited to certain percentages. URPF, no tax benefit. Public Provident Fund, there are only 2 items. That is employees' contribution for which ATC deduction. Interest is exempt. Lump sum is also exempt. The last topic which we are discussing is superannuation fund. Superannuation. Superannuation, again, that is not a compulsory account which has to be opened. It's not like PF. As I told you, RPF is a compulsory statutory obligation of the employer, but superannuation fund is not. For the same reason, if you want to claim exemption under section 1013, that superannuation fund shall be approved by the department. You have to make an application to the income tax department mentioning where you have opened the superannuation fund, in which type of investments, funds we have kept invested your fund, everything. The department is convinced that this fund is open for the benefit of the employee, they would give an approval, and then you can claim exemption. So the first and foremost thing is to get an approval for your superannuation fund. It's very much similar to a PF. Employer will contribute, employee will contribute, you get interest and you get lump sum. So at the time of retirement, here there are 2 savings coming to your pocket, one from PF and the other one superannuation. So double benefit. For that purpose, employers may open superannuation funds, but go and get an approval first, then only you can claim exemption. Employers' contribution, here what we do is, see, employer nowadays, they contribute to 3 different types of funds: provident fund, superannuation fund, pension fund. All these funds together, if employer's contribution exceeds 7,50,000, that excess is taxable. Excess is taxable. All these funds taken together. Individually, you contribute to provident fund and the percentage exceeds 12%, that is taxable. Cumulatively, all these 3 funds together process 7,50,000, that excess is taxable. Did you get that? Individually, employer contributes more than 12% of salary to PF, that excess is taxable. Cumulatively, all these 3 funds added together, employer contributes more than 7,50,000, then also that excess is taxable. Employee's contribution, you can claim ATC. Interest on that excess of 7,50,000 is also taxable. There is a formula, you would have seen that PC divided by 2 into R plus PC1 plus TP1 into R. That interest also in all those 3 funds together, if on contribution excess of 7,50,000, that is, if the employer contributes 9 lakh to provident fund, superannuation fund, and pension fund added together, employer contributes 9 lakh to all these 3 funds together, 1,50,000 is taxable. Interest on 1,50,000 is also taxable, and interest is calculated by using this formula. Okay, and lastly, lump sum received is also exempt from superannuation fund, provided this is approved superannuation fund. So these are the seven things which we had discussed in respect of salary. In respect of salary, which we had discussed seven types of exemptions. Seven exemptions were for gratuity, pension, leave salary, retrenchment compensation, PRS compensation, PF, and superannuation. Okay. We'll take a 10 minutes break, a short break, and then we will go for exemptions in relation to allowances. As I told you, there are only three exemptions for allowance: HRA, special allowance, and foreign allowance. We'll take a short break of 10 minutes, and then I will rejoin. So we'll start exemptions under section 1013. We'll start with the exemptions relating to allowances now. We'll start with exemptions relating to allowances now, right? Allowances. Exemption relating to allowances, they are only four. Okay, only four. One is regarding 1013A, that is HRA. Then there is a special allowance under 1014, special allowance under 1014. And finally, there is a foreign allowance under 107. There is one more exemption as well, that is relating to High Court judges and Supreme Court judges and the employees of UN. I think that will be not relevant. And from examination point of view, there are only three exemptions. One is HRA 1013A, second is special allowance under 1040, and the third one is 107. So let us see what is the first exemption regarding HRA 1013A. Exemption in respect of HRA is again calculated as per the rule of three. See, most of the cases we are making exemptions under three steps and we choose whichever is lowest. Here also this list of these three. There are three calculations which we have to make. When we think about HRA, we know that this HRA is paid for the purpose of meeting your expenditure by way of rent. So definitely, while granting exemption, we also always have to compare how much is your expenditure in relation to rent. All right. So we will be comparing all these three things and we'll be claiming exemption. Exemption for HRA, if you're staying in bigger cities, it is normally understood that bigger cities, you may have to incur expenditure by your rent higher. So exemption is also higher. So if you're staying in bigger cities, in metros, your exemption will be 50% of your salary. And in all other places, it will be 40%. Now, the cities which are classified as metros for the purpose of section 1013A are only four: Delhi, Chennai, Mumbai, Kolkata. Only these four cities have been classified as metros for the purpose of 1013A. Anyway, 50% is exemption if you stay in these four cities, and all other cases, your exemption is 40%. All right. Then the second step is rent minus 10% of salary. What does that say? At least 10% of your salary shall be paid as rent. Only then you can claim exemption. Let's take an example. Your total salary per year is 1 lakh. Total salary per annum is 1 lakh. 10% of salary comes to 10,000. Rent paid for the year is only 9,000. You are not paying at least 10% as rent. Then there is no exemption. So if you want to claim exemption, rent paid shall be more than 10%. Otherwise, in the example which I just told you, 9,000 minus 10,000 will come to a negative figure. Salary is 1 lakh, 10% is 10,000. Rent paid is only 9,000. Rent paid minus 10%. 9,000 minus 10,000. That is minus 1,000, negative figure, no exemption. Even if you don't pay any rent, 0 minus 10% of salary, that will come to a negative figure, no exemption. Understood. So what you have to see is ensure whether at least 10% of salary is paid as rent. Otherwise, no exemption. HRA received during the period rent is paid. I'll explain that. It's not just HRA received. It is HRA received during the period rent is paid. I'll explain that. What is salary for this purpose? Salary means basic salary, common definition. Basic salary plus DA provided by terms of employment plus commission paid on fixed percentage of turnover achieved by the employee. All right. Basic salary plus DA provided by terms of employment plus commission paid on fixed percentage of turnover achieved by the employee. Now, salary is calculated on due basis during the period rental accommodation is occupied. See, I was given HRA for the whole year, but for 9 months I was staying with my parents. I did not pay any rent. I stayed in a rented accommodation only for a period of 3 months. I stayed in a rented accommodation only for a period of 3 months. In such a case, what we do is we take rent only, we take salary only for 3 months. Take 3 months salary, 3 months salary into 50% or 40% as the case may be. In case number 1, in point number 1. 3 months salary into 10% for point number 2. Similarly, HRA received shall also be taken only for 3 months. I can give you exemption only for 3 months HRA. When you calculate exemption, everything is revolved around that rented accommodation. Exemption is revolved around that rented accommodation. If you take rented accommodation only for 3 months, exemption is only for 3 months salary into 50%. HRA received is only taken for 3 months salary, 3 months. See, the purpose of HRA is to pay rent. If you don't pay rent, then we don't consider anything. We don't take salary as well, right? So 9 months you pay, you stay with your parents. 3 months you pay HRA. You pay rent. Employer gives you HRA for the whole year. Employer gives you HRA for the whole year. 9 months you stay with your parents. 3 months you stay in rented accommodation. Take only 3 months salary. That will be 50% or 40%. Take only 3 months HRA. Only for that you can claim exemption. While calculating exemption, I take only 3 months HRA. I hope that is understood. Now we come to section 1014. 1014. 1014 is special allowances. 1014 is special allowances. Special allowances, there are two types of special allowances. One is special allowance which is given for official purpose. And the other is special allowance which is given for personal purpose. The difference is allowances which are given for official purpose will be allowed as exemption only if it is spent for that purpose. Spend it. Only then I will give you exemption if it is an official allowance. If you don't spend, again, spend it for that purpose for which it is given. Spend it for the purpose for which it is given. Do you understand? Let us see which are the various types of allowances that are given for official purpose. One is traveling allowance or transfer allowance. Traveling or transfer. That is, you are traveling out of station. You are traveling out of station. You are traveling to your normal place of duty is in Chennai. You are traveling to Bangalore. You have to incur a lot of expenditure many times when you are traveling to Bangalore. You are a marketing specialist, so you might be traveling across the country. Employer, instead of reimbursing the actual expenditure, he gives you fixed allowances. All right. So spend it for the purpose for which it is given. Traveling allowance or transfer. You are transferred to Bangalore. Even when you have to travel up to Bangalore, for that employer might be giving you allowance. You may travel in your own car, you may go in bus, you may go in train, you may take a flight, whatever, that is up to you. But spend it. Only if you spend, I'll give you exemption here. Second one is daily allowance. You are again on an official tour. When you are on an official tour, you have to incur expenditure for your daily needs like food and lodging. So employer again gives you a certain amount for your lodging purpose. Employer might be giving you 5,000 per day. You may stay in a lodge which has a rent of only 2,000. You may stay in a 3-star hotel or a 5-star hotel which has a rent of around 7,000. That is all your wish. But employer gives you a fixed daily allowance of 5,000. Spend it. Then I will give you exemption. Conveyance allowance. What is the difference between traveling and conveyance allowance? Traveling means you are going out of station. As I told you, Chennai, you are going to Bangalore. Your place of duty is in Chennai, you are moving to Bangalore. You are going to Bangalore. Conveyance means that is local conveyance, meaning your place of duty is in Chennai. The employer asks you to go to bank in the next street. The employer asks you to go to income tax office, again within the same city. Employer asks you to travel up to ICAI Kavin, which is in the same city. So city travel within the same place you are going, and then employer gives you certain allowances that is called as conveyance allowance. Understood? So conveyance allowance again, spend it for that purpose. Academic research allowance, the stipends normally given is called as academic research allowance. So spend it for the academic purposes. You can claim exemption. Uniform allowance, many organizations have their own uniforms. Employer pays you money to purchase these uniforms or to maintain those uniforms. Whether purchase or maintain, if done properly, if you have spent money properly, then I will give you exemption. Helper allowance, I'm talking about official helpers here. Official helpers means personal assistants or personal secretary you have. So when you are going for an official travel, your personal assistant also accompanies you. Expenditure has to be incurred on that personal assistant as well in the form of traveling, daily, food, etc. Expenditure spent on that person will also be allowed as exemption, provided spend it. Only if you spend, I'll give you exemption and spend it. Make sure that you are spending it for that purpose as well. Usually, when allowance is given, the purpose of allowance is in that allowance itself. Traveling allowance for the purpose of travel, daily allowance for daily needs, conveyance allowance, academic research. So the allowance name usually carries the purpose. So make sure you spend for that purpose, then we can claim exemption. Okay, so that is regarding official purpose, section 1014. There is one more set under section 1014. They are allowances which are given for personal needs, personal purposes. And the difference is that the allowances which are given for personal purpose, exemption can be enjoyed even if it is not spent. Even if it is not spent. Because in this case, exemption is either allowance received or amount mentioned in income tax rule 2BB, whichever is lower. The amount of exemption is either allowance received or amount mentioned in income tax rule 2BB, whichever is lower. Okay. We'll see what is the amount which is mentioned in income tax rule 2BB. So I repeat, this allowance need not be spent. Personal allowances need not be spent. Need not be. Even if you don't spend, I'll give you an allowance. If it had been a traveling allowance, the employer gives you 100, you spent only 80. I claim exemption. The employee can claim exemption only for 80 rupees. Balance 20 is taxed. Employer gives you 100, you spent 120. Entire 100 is exempt, nothing is taxable. But this is not the case in personal allowances. I won't look into the amount which you have spent. We have fixed a specific amount that is claimed as exemption. Of course, compare with that actual allowance, whichever is lower. All right. So what are those types of allowances? Tribal area allowance or scheduled area allowance, the resident specified areas, notified areas, and you are working in those areas, you can claim an exemption of 200 per month. Like 500 per month is allowance receipt, you spend 100, but even then we can claim an exemption of 200 per month. Understood? Second is allowance for transport employees. Transport employees means employees who are working in transport undertakings, like the road transport corporations, the railways, then there will be Indian Airlines. Employees who are working in transport undertakings, they don't have a regular place of duty, and hence they'll be usually given BATA, extra BATA. And when they receive that extra BATA, BATA is a usual name which we call, they can claim exemption, and that is lower of 70% of allowance or 10,000 per month, whichever is lower. This is the amount mentioned in Rule 2BB. Compare that with the actual allowance, and then whichever is lower. That is the exemption. Transport allowance. What is the difference between transport allowance and conveyance allowance or traveling allowance? See, transport allowance means allowance given to meet your travel between office and residence. Residence and office. Commute between office and residence. For that allowance given, that is transport. Traveling and conveyances, after reaching office, you are going out for official purpose. Do you understand? This is for coming to office, you are given an allowance. But this allowance exemption can be enjoyed only by handicapped persons. The deaf or the dumb or the blind or those who are physically handicapped, some problem with movement they have. So they might have to take a cab or an auto. It might not be comfortable for them to use a public transport. So they might need their own transport. Employer might give extra amount for that. That is called transport allowance exemption, or amount mentioned, Rule 2BB is 3,200 per month. Education allowance and hostel expenditure allowance. So children are studying in schools or hostels, and then employer might be giving you extra amount to meet that expenditure. Exemption is but very small amount. This small nominal amount they have allowed as exemption. It's 100 per month per child, up to a maximum of 2 children. Hostel expenditure is 300 per month per child, up to a maximum of 2 children. Exemption is enjoyed only for 2 children. And education allowance and hostel expenditure allowance is the most commonest of the allowances which are asked for exam. Almost every question on salary might have these: education allowance and hostel expenditure allowance. Education is 100 per month per child. Hostel expenditure is 300 per month per child. Maximum 2 children. Underground allowance, those who are working in mines. Okay. suppose they are working in uncomfortable climatic conditions, they can claim an exemption of 800 per month. Similarly, for those who are working in Lakshadweep and Andaman and Nicobar Islands, you can claim an exemption of 3,250 per month. So these are the amounts which are mentioned in Rule 2BB. Compare that with the allowance received, and whichever is lower is the amount of exemption. Okay. The last case is 10.7, that is foreign allowance. Earlier, when we had been discussing upon residential status, somebody deemed accrual. I think we were discussing about deemed accrual section 9. There I told you, when government pays you salary, that is Indian income. Government pays you salary, that is Indian income. So government might pay you salary, government might pay you allowance, government might pay you perquisite. Of these, allowance and perquisite are exempt under 10.7. Allowance or perquisite given by Indian government to employee being an Indian citizen for entering service outside India is exempt. Salary is taxable. Salary is taxable. All these three are Indian incomes. Salary given by government, allowance given by government, perquisite given by government. All these three are agreed Indian income. But of this, I will give you exemption for allowance and perquisite. So only salary is taxable. Okay, allowance and perquisite given by Indian government for a government employee working abroad is exempt, and that government employee is an Indian citizen. All right. So we have completed exemption for allowance as well. Okay, there were 3 exemptions: HRA, special allowance, and foreign allowance. Now, regarding educational expenditure, I think I'll give you a simple example for that, because certain questions, they might confuse you. So let me give you an example. An employer gives you total education allowance of 3,000 for 3 children. See, for 3 children together, all 3 children, you get 3,000. Of this, you spent 2,500. 2,500 is spent, but this amount is immaterial. This we need not look into. Okay, this we need not look into. This is not required. This is not required. 2,500 spent. Personal allowance, I will never look into the amount spent. Instead, what I have to see is how much is the amount of exemption given under 2BB. The amount of exemption given under 2BB is 100 per month per child, up to a maximum of 2 children. Up to a maximum of 2 children. So let us see how much of exemption can be claimed in this case. This is amount specified in Rule 2BB. Amount of exemption is allowance received or 2BB amount, whichever is lower. Or 2BB amount, whichever is lower. But see, this allowance received can be taken. Exemption is available only for 2 children. Is it not? Exemption is available only for 2 children. So allowance received shall also be taken only for 2 children. Allowance received shall also be taken only for 2 children. You cannot take 3,000 fully. This is the amount of exemption. This is the amount of exemption. Exemption is allowance received or 2BB amount. 2BB says that exemption is given only for 2 children. So what does that mean? Allowance shall also be taken only for 2 children. So how much is allowance received for 2 children? 2,000. And 2BB amount is 100 into 2 into 12, which is equal to 2,400. Whichever is lower is exempt. So exemption is only for 2,000. So education allowance taxable is 1,000. Education allowance taxable is 1,000. You cannot deduct 2,400 from 3,000. Because when you come to the exemption part, think of only 2 children. When you come to the exemption part, exemption is available only for 2 children. So exemption allowance received shall also be considered only for 2 children. Allowance received for 2 children or 2BB amount, whichever is lower. Okay. So that was one thing which I had to explain in relation to education allowance. So let us come to the format. When we compute the format for salary, there is, how did we start with? We take all salary. Then we take income by way of allowance. Okay, income by way of allowance is taken. And then we have also taken perquisites. Okay, we have also taken perquisites. Now we have to take perquisite. We have to take perquisite. We have to value those perquisites. We have to value those perquisites. And valuation of perquisites is done certain specific rules because everybody should get the same answer when we value perquisite. So we have to follow that standard rules for valuation. And there are around 22 or 23 different cases for valuation of perquisites. But in majority cases, we'll apply the common sense logic that value of perquisite in the hands of employee is the expenditure incurred by employer. Majority cases. By heart learning is required only in specific cases. Just remember the percentages and all. But the idea behind valuation of perquisite is the amount which is to be taxed in the hands of employee is the amount which is incurred as expenditure by the employer. Okay. So we'll first deal with the perquisite. The first of the perquisite which we have to discuss is rent-free accommodation. Rent-free accommodation. The first of the perquisites we have to discuss is rent-free accommodation. And this rent-free accommodation. First of all, let me explain rent-free unfurnished accommodation. Okay, rent-free unfurnished. There is only house, no furniture. Only house, no furniture. How to calculate value of rent-free unfurnished accommodation? As always, we divide employees into two, right? Government employee and non-government employee. Government employee and non-government employee. Government employee, actually, there is no need to calculate because the value of perquisite is the license fee which is fixed by government. License fee which is fixed by government. Government has already fixed the license fee. Government has fixed the license fee. There is no need for calculation. There is no need for computation from our part. There is just the reference work. You Google it and we identify the license fee for specific grades of employees. That amount which is fixed by government is the value of perquisite. Okay, so nothing much is to be explained in relation to government employees valuation. Now we are calculating non-government employee. Again, in the standard example which I have been putting throughout, I am a BSNL employee. I'm a non-government employee. I'm working with BSNL. Employer is giving me quarters. BSNL is giving me quarters. How to calculate value of perquisite? This quarters may be either it is owned by the employer or the quarters is taken on rent by the employer. Okay, the quarters is either owned by the employer or it is taken on hire by the employer. All right. If it is owned by the employer, value of perquisite depends upon the population again, HRA, similar to HRA. It depends upon the population of the city where you are allotted this accommodation, where you are occupying this accommodation. Smaller cities, smaller value, bigger the city, bigger the value of perquisite. Okay, because the expenditure of the employer might be higher, so your benefit is also higher. All right. So if you are staying in a, actually regarding this, before I discuss this valuation, let me explain something. There has been an amendment in this section, in this area, in value of rent-free accommodation. And the amendment was introduced with effect from 1st September 23. It was a notification that was issued by the government, and notification was issued, I think, on 24th August. And this was effective, this is effective only from 1st September 23. 1st September 23. So what we do for this year, for assessment year 24-25, when we calculate the value of perquisite, the rule has been changed from 1st September. Up to 31st October, we have to make the calculation as per the old rule. And from 1st September onwards, we have to make calculation as per the new rule. 5 months, April to August. 5 months, one rule. 7 months, another rule. So we have to calculate salary for 5 months and 7 months separately. And 5 months salary into old rule, 7 months salary into old rule. I'll explain with an example. Okay, I'll explain with an example. Let me first explain what was the old rule. That is the rule up to 31st August. This rule is effective only up to 31st August. This rule, which I am explaining now, this is applicable only up to 31st August because all the limits and the percentages have been changed from 1st September. Okay. So up to 31st August, the rule is like, if you are staying in a city having a population of less than 10 lakh, if you are staying in a city having a population of less than 10 lakh, value of per visit is 7.5% of salary. 7.5% of salary. If you are staying in a city having a population between 10 and 25 lakhs, per visit will also be higher, 10% of salary. If you are staying in a city having a population of more than 25 lakhs, more than 25 lakhs, that is the biggest cities, then your value per visit will be 15%. That is 7.5, 10%, 15%, depending upon the population. Now, if this accommodation is hired by the employer might be incurring expenditure by way of rent, is it not? So we have to compare rent paid by the employer as well. Before we identify the value per visit, we have to compare with that. So if it is a hired accommodation taken on hire by the employer is paying higher charges. Higher charges or 15% of salary, whichever is lower. Higher charges or 15% of salary, whichever is lower. Okay, this is the rule up to 31st August. 31st August. Now, 1st September onwards, both the population and rate has been changed. So let us see what is the rule from 1st September onwards. 1st September. Here again, you have to do it in 2 cases. That is, accommodation might be, what is that? Accommodation might be owned by the employer. Accommodation might be owned by employer or it may be hired by employer. Hired by employer. If it is owned by employer and you are staying in a city having a population up to 15 lakhs. See, it is 15 lakhs. Earlier that was 10 lakhs. 15 lakh, then value per visit is 5% of salary. It's only 5%. Earlier the lowest was 7.5. Then the population is between, you are staying in a city having a population between 15 lakhs and 40 lakhs. Then it is 7.5%. 7.5%. Okay. This is applicable from, when is this applicable from? 1st September 2023. This is applicable from 1st September 2023, right? Then, if you are staying in a city having a population of more than 40 lakh, above 40 lakhs, then value is 10% of salary. So earlier that was 7.5, 10 and 15. Now it is 5, 7.5 and 10%. 5, 7.5 and 10%. And if it is hired by the employer, again, there are 2 calculations. Rent paid or 10% of salary, whichever is lower. Rent paid or 10% of salary, whichever is lower. Earlier, you remember that was 15%, but now the maximum percentage is only 10%. So when rent is paid also, we take only 10% of salary. Okay. So please see that the valuation has changed from 1st September 23. So we have to make calculations for 2 periods separately. Now I will give you a problem and we will see how this calculation is made for 2 different periods. Okay. Before that, one more thing, let me explain. What is salary for this purpose? For the purpose of rent-free accommodation, what is salary? For the purpose of rent-free accommodation, what is salary? For this purpose, salary means basic salary plus DA provided by terms of employment plus bonus plus commission plus fees plus taxable portion of allowances plus other monetary payments by whatever name called. Meaning everything which is given by the employer will be added together. Almost everything which is given in cash by the employer will be added together before we apply that percentage. And all those will be added together and we apply whatever 5%, 7.5%, 10%, 15%, whatever rates which are given there. So it's easier to remember what are the things that are not to be considered. What are the things that are not to be considered while valuing house? While applying that formula of 5% or 10%, you exclude these 4 things. All these 4 things excluded, add other things, apply percentage. So what are to be excluded? 1, DA not provided by terms of employment. Okay, DA not provided by terms of employment is excluded. Employer's contribution to Provident Fund. Employer's contribution to Provident Fund, that is not be considered for valuation of house. When you're finding out salary for valuation of house, employer's contribution to Provident Fund is not to be added, even if that exceeds 12%. All exempt portion of allowances are to be excluded. Okay, exempt portion of allowances are to be excluded. Then the last thing, perquisites. All perquisites are to be excluded. Perquisites. Employer is paying you electricity bill, employer is taking care of your medical bills, employer is paying you domestic servants. So many personal benefits are being extended by the employer, but all those perquisites are to be excluded. Add all other things, apply 5% or 7.5% or 10%. That is your value of perquisite. Okay. So let us take an example and see how do we value this. All right, how do we value? We do this separately for 2 periods. Basic salary is 1,92,000. DA provided by terms of employment. DA provided by terms of employment is 19,200. Education allowance received is for 2 children, only for 2 children, right? He has only 2 children. So he has received education allowance for 2 children at 6,000. He has also received traveling allowance. Traveling allowance 12,000. Of that, 60% is spent for official purpose. Okay. 60% is spent for official purpose out of traveling allowance. Then what else? Special allowance. Name is not specifically given. Some special allowance is given. Everything is per month. Okay. Sorry, per year, 30,000. All these figures I'm giving for 1 year. Special allowance is given 30,000. Then what else? Let us take a perquisite. Employer pays domestic electricity bill. Domestic electricity bill of mine that is paid by employer, which he pays is 12,000. Okay. Now finally, employer also gives you a rent-free accommodation. Rent-free accommodation. Rent-free accommodation, it is taken on rent by the employer. Taken on rent. And the employer is paying a rent of 7,500 per month. I don't know how will the calculation come to, but even then, let me take on this. So these are the various items which are given by the employer for the year. You have to compute value of perquisite in respect of this accommodation. Value of perquisite in respect of accommodation, how much will that come to? What I have to calculate first is salary for the purpose of valuation of house. Salary for the purpose of valuation of house. That is first part what we identified. And once you calculate this salary is calculated just for the purpose of applying that percentage, that applying percentage of 10%, 15% or whatever. Just for that purpose, I'm calculating the salary. For that, what all you have to include? We have to include basic salary. We have to include DA as well, because DA is provided by terms of employment. Education allowance, I have to include only the taxable portion. Even traveling allowance, I have to include only the taxable portion. Whatever exemption is there has to be excluded. Special allowance, the name of the allowance is not given. If you have given that this tribal area, I would give you 200 per month exemption. If you tell that it's silent duty, I'll give you 3,250. But in the absence of the nature of allowance, I cannot give you an exemption in respect of that special allowance. Domestic electricity bill, again, there is a perquisite, so that is not to be included. Okay, that is not to be included. And then rent-free accommodation. So we'll find out what is salary for the purpose of valuation. Let me write down one by one below the other. Basic salary is 1,92,000. DA I have to consider because it is provided by terms of employment. So 19,200. Education, inner column, 6,000. Less exempt under section 1014. Exempt under section 1014. This 100 per month per child up to a maximum of 2 children. You have only 2 children. So you have to claim, you can claim exemption 2,400, 3,600. Traveling allowance. Traveling allowance it is 12,000. Again, I can claim exemption because that is spent for official purpose. It is 60%, so 7,200. So taxable portion is 4,800. Domestic electricity bill need not be considered for this purpose because domestic electricity bill is not to be considered for this purpose because that is a perquisite. Perquisite is not to be considered. So total comes to salary for valuation of houses 2,19,600. But this is salary for a period of 12 months. 12 months. I forget this because 5 months one calculation, 7 months another calculation. So I'll prepare another table up to 30th August, 31st August it is, 31st August 2023. 5 months there is one calculation. From September onwards, from 1st September, there is another calculation. Let me first write down how much is salary for this period. How much is salary for this period? Salary is, here it is, 2,19,600 into 5 by 12, right? And here it is 2,19,600 into 7 by 12. We'll put this in brackets. Okay, so salary is identified. Now let us see value of house. Value of house. Value of houses up to 31st August. If the accommodation is taken on rent, let us see what was the rule. Up to 31st August, it is 15% of salary or rent paid by employer, whichever is lower. Okay. So 91,500 into 15% or 7,500 into 5 months salary, 5 months, 5 months salary, and also 5 months salary into 15% and also 5 months rent. So that will be lower of 91,500 into 15% will come to 13,725 or 7,500 into 5. How much is that? 37,500. So lower is, I take the lower end. Lower is 13,725. Okay. This is value of per visit for 5 months. From September onwards, as I told you, the rule has changed. The rule has changed from September. It is rent paid by employer or 10% of salary, whichever is lower. So how do we calculate that? 1,21,800 into 10% or 7,500 into 7. 12,180 or 7,500 into 7 will come to 52,500. So lower is 12,180. The total value of houses. Total value of houses 13,725 plus 12,180. 25,905. This is final value of house for the whole year. So this is how you should calculate. This is how you should calculate when you find out rent-free accommodation. All right. Okay. So for this assessment here, we have to calculate because amendment was introduced only from 1st September 2023. This is effective from 1st September. That is a word they have used in the notification. So this is the way we have to calculate. Even if it is owned by the employer, a similar calculation. The only thing is here there will not be that 5 months. Apply that 5, 7.5 or 10 after September. If it is before September, 7.5, 10 or 15, comparing the population for the period. So this was the case where the accommodation is owned by the employer. Okay, that was a rent-free furnished accommodation, rent-free unfurnished accommodation. That was the case which we just discussed. Rent-free unfurnished. There is no furniture provided. Only houses provided by the employer. What if furnished accommodation is provided? Furnished. If a furnished accommodation is provided, what we have to do is we have to take the value of unfurnished house. Along with the value of unfurnished house, we'll also take the value of furniture. Value of furniture is added extra. And what is taken as value of furniture? Value of furniture, again, that may be hired by the employer, that might be owned by the employer. Okay, furniture might be hired by the employer or owned by the employer. Again, apply this common sense logic. When an asset is owned by the employer and I'm using this asset, what is the expenditure, possible expenditure to the employer? The possible expenditure is the depreciation in the asset. And the depreciation we assume to be 10% per annum on cost. Depreciation is 10% per annum on cost. Okay. So if the asset is owned by the employer, employer's expenditure is the depreciation because I'm using it. And depreciation rate is fixed at 10% per annum. On the other hand, if the furniture is hired by the employer, then higher charges will be taken as value. Higher charges. So add value of furniture with the value of house, that will give you value of furnished accommodation. Now again, salary is calculated on due basis during the period rented accommodation is occupied. Salary is calculated on review basis during the period rental accommodation is occupied. As we discussed in the case of HRA, if you're staying in a rented accommodation only for 3 months, only take 3 months salary, apply the percentage on 3 months salary, right? And there are a lot of exceptions. In certain cases, we don't charge value of per visit. We don't charge value of per visit. They are enjoying, the employees enjoying the benefit, agree, but there is no per visit. Which are the cases where there is no value of per visit? One is the per visit is offered to the judges of High Court or Supreme Court. Then there is no value. Accommodation is provided to Office of Parliament, Union Minister, or Opposition Leader of Parliament. The politicians, they enjoy, there is no per visit. Accommodation is provided in a remote area. See, there is no option other than to stay in the accommodation which is provided by the employer. In that case, there is no value per visit. Then point number 4, The employee has been transferred from Chennai to Bangalore. Chennai accommodation is not like he's retaining that accommodation because his family is staying in Chennai, and the employee joined Bangalore office and he is enjoying Bangalore accommodation as well. Okay, family has not vacated Chennai property. Family is in Chennai, employee is in Bangalore. Meaning at the same time, the employee is occupying two residential accommodation provided by the same employer. And he had to occupy these two accommodation because he was transferred. It was as a result of transfer that you are occupying two accommodations. In that case, what does this act say is that for a period of 90 days, even if you are enjoying two accommodations, you need to take only one. Even if you are occupying two accommodations, you need to take only one house in the valuation. Okay, and that house which has a lower value, obviously, we would take only that house which has a lower value, either Chennai house or Bangalore house which has a lower value. But even after 90 days, that is even after 3 months, you continue occupying both the houses. Then from that month onwards, both the houses will be taken into valuation. All right. So let us take an example. Let me explain this again with an example. What does that last point say? On account of transfer, you are occupying two houses simultaneously. Initially, you were in Chennai. Up to September, you were in Chennai. Okay. Value of house is 15,000 into 6. Per visit is 90,000. Let's just assume 15,000 is my assumption. Lower whatever we calculate and we get 15,000. October, November, December. 3 months. October, November and December. 3 months. You are occupying both Chennai and Bangalore. Both Chennai and Bangalore. Chennai value is 15,000 and Bangalore value is 20,000 per month. We will take only one. 3 months you need to take only one. So we will choose that one which has a lower value. 15,000 into 3, 45,000. Okay. January, again you occupy both Chennai and Bangalore. From now onwards, I have to include both. So value of per visit will be 15,000 plus 20, that is 35,000. February, March, you occupy only Bangalore. You have vacated your Chennai property. Your family has joined you in Bangalore. So now you occupy only Bangalore property. 20,000 into 2, 40,000 will be the value of per visit. So what does this mean? On account of transfer, if you occupy two properties simultaneously, you need to take only one, and that one means that one which has a lower value. That one house which we take is that one which has a lower value. Okay. So this will be the total value of per visit. 90,000 plus 45,000 plus 35,000 plus 40,000 is the total value of per visit. Even after 90 days, even after 3 months, you occupy both the houses, then both will be added. So January you occupied both, but February and March you occupied only Bangalore. You vacated Chennai property. Then only Bangalore property. That is over. We'll discuss two more. Let me complete this accommodation related part in this session. Third case is accommodation at concessional rent. Accommodation at concessional rent. What does it mean? Accommodation at concessional rent means case 1 and 2, we were talking about rent-free accommodations. Rent-free. That is, no rent was paid. Absolutely free. You are staying in that house absolutely free. Now it is accommodation at concessional rent. Meaning, the meaning is you are paying, the employee is paying certain amount to the employer. Employee is paying certain amount to the employer. You are paying a nominal rent to stay in that quarters. You are paying a nominal rent to stay in that quarters. In that case, what will be value of perquisite? Find out as if it is a rent-free accommodation. See, in this example, which we had just done, we had found out that value of rent-free accommodation is 25,905, is it not? Value of rent-free accommodation is 25,905. Now, my employer says, you have to pay me 1,000 per month if you have to stay in this house. My employer says that you have to pay me 1,000 rupees if I have to stay in that house. What shall be done with that? 12,000, 1,000 per month, 12,000. What shall be done? Deduct it. Because I'm enjoying that benefit only by paying an amount of 12,000. So this is accommodation at concessional rent. This is accommodation at concessional rent. Value of accommodation at concessional rent is 25,905 minus 12,000. This is value of accommodation at concessional rent. You are paying something and enjoying it. And this being amount recovered from employee, this calculation which we have to make, amount recovered from employee, this we have to make in almost all the cases. All the cases we finally do this step. When we are computing a value of perquisite, the last step which we do is amount recovered from employee will be deducted. Because you are enjoying this benefit by paying something. So that amount paid has to be deducted when the benefit is calculated. So this step is a step which we do in any perquisite valuation. Find out the value of accommodation, find out the value of perquisite as if it is enjoyed free, then deduct the amount which you are paying back. Balance is value of accommodation. All right. One more case we will discuss and we will wind up the session. Fourth point is you are staying in a hotel. The employer is not providing you a quarters. Instead, the accommodation is provided in a hotel. The accommodation is provided in a hotel, then value of perquisite is lower off. You make two calculations, lower off 24% of salary or rent paid by employer. Employer is paying the hotel rent. So definitely we have to compare with that. 24% of salary we have to take. It's not just house. We are taking 24% because when you are staying in a hotel, you might be enjoying a lot of other amenities as well. Is it not? You might be enjoying the swimming pool sometimes. You might be enjoying the gym in the hotel. Or you might be enjoying the laundry services in the hotel. So the rate is at a higher side. Because house, we'll be taking only 10% or 15%, but here we are taking 24%. So 24% of salary or rent paid by employer. Now again, here there are exceptions. Every rule has an exception, right? Certain cases we don't value perquisite. Here also, hotel also we don't take the value of perquisite in two cases. One is hotel accommodation is given only for a period of 15 days. The total stay in the hotel does not exceed 15 days. Okay. And the second case is you are staying in a hotel, you are given accommodation in a hotel for 15 days and then also on account of transfer. Again, a common example, Chennai to Bangalore, you have been transferred. You landed in Bangalore, immediately you did not get a house. So for the time being, employer put you in a hotel. And that stay in a hotel was only for 10 days. After 10 days, we moved to the house which was provided by the employer. There is no need to calculate perquisite for those 10 days. Because you are staying in a hotel and that hotel accommodation is given only for a period of less than 15 days. Both the conditions have to be satisfied, both. Stay in a hotel less than 15 days on account of transfer. Then there is no need for value perquisite. Okay. So we'll wind up the session for the day. We'll continue in the next session.